Uh, Let me see if I have been given. Yes, I have been. Perfect. Great. So we have only about 25 people, 24 people right now. So there's a couple of people who have not entered your name, not couple, more than a couple. It would be nice if you could enter your name, guys, so that I can refer to you if you are typing some doubt, so that I can address you. You need not log out. You can just go to the list of participants, click on your name. There will be an option called rename. You can add your name along with your unique ID. And there is someone who has just entered SIAAD. The 4-digit number is, or whatever the 7-digit number is missing. Please enter that as well. That is for the purpose of attendance. The name is for my purpose, so that I can call you. I can read out your name if you're asking me something. Please do that. Okay, perfect. Whoever just texted saying visible 208825, please enter your name as well if you have not already done it. Okay, it already done. Karan, thank you. I just noticed. Perfect. Okay, so is someone going to come on video? Is there anyone who's comfortable? If you're comfortable, you can come on video so that I get to see your reaction when the class is happening. That'd be good. Not a compulsion, but if you are comfortable, if you are in the right setting, if you are dressed appropriately, if your room is appropriate, then you can come on video. Just 2 or 3 people, or even 4. Okay, so we do have a few people. Great. Okay, what was the last topic that we did? If I'm not wrong, I finished direct taxes. I did not start with indirect taxes. Is that right? A couple of weeks ago, did I finish with fringe benefits tax? Okay, not just me. Even you are looking at it for the first time now after the last class. I see. You're looking at the notes for the first time since last class. Okay. What? Just wait. Did we finish indirect taxes? Oh wait. My apologies. My apologies. I got confused with another batch. Your public finance was already done by ma'am, right? Correct. Sorry, my bad. I ended the public finance for you, and then okay, I got a little confused with another batch. Really sorry about that. We are in the middle of money then. Sorry about this. Yeah, I now recollect. There was one part about G6 and all those, which you said was not done for you. We said after finishing money, I'll do that part alone. That was in this class, right? Okay. So I was on a 2-week vacation. After 1 year, I went to my hometown for the first time after this entire break. So my mind is completely off. I'm in a completely relaxed state of mind. I'm struggling to recollect things. Sorry about that. But I'm back to this life now. So I'll slowly get back. So revaluation reserve I have done. Okay, foreign exchange reserve, the various reserve systems is what I have done. All right. So did I tell you government's role in currency management? Just about 3 points there. 2-3 points that they print, that they mint coins, they coordinate with the Reserve Bank of India. I gave you the list of role of Reserve Bank of India. I explained some parts of it. Then I specifically went into reserves and I explained that. The next part that is left is quantity, determining the quantity, how to determine the quantity and the circulation. So that is what is the next topic. So determination of quantity of money in an economy. This is the heading that we have to look at now. Determination of quantity of money in an economy. Okay. Apologies for all the confusion. There's some other batch where I had left it at that point, so that is why this happened. Anyway, so a question to you before I give you the answer. How much money do you think should be there in the economy? What would be the basis on which money would be printed in the economy? So RBI and the government have to take a decision. This much amount of money has to be there. This quantity of money has to be there. Okay. How do they decide that? What is your thought about it? Tell me what you think. You type in, or if you want to answer on video, you can do that as well. Archana says based on our reserves. Raj is asking this comes under which function? Currency management, the first function that I told you about. That is the only function that we'll be discussing in this chapter. I told you that also in the last class. I gave you 6 functions of RBI. I told you only one we'll be discussing in this topic. So it is under that function, currency management. And within currency management, we read 2 headings: government's role in currency management and RBI's role in currency management. Government's role, we ended with printing coins and coordinating with RBI and printing 1 rupee note, of course. And then coming to functions of RBI, we looked at what are the various functions, determining how much money should be there, then the denominations, the quality, the security features, the size, and all those, the design features. We looked at that. Then we said printing. Then we said maintenance of that, circulation, then maintenance, then reserves. So that is what we had learned. And then about reserves, I had gone into the detail. About denomination, I had given you an idea about the formula of 125. I told you about that. With respect to printing, I told you I'm not going to go into the depth. You will have to just read up about what are the various printing presses that RBI has, the mints that the government has. You can take a look at it. Those sort of factual information. If you want, you can do that. Okay. So yeah, now we are at this heading of how to determine the quantity of money. Along with it, we'll also look at circulation, not as a separate heading in this topic itself. So my question to you is, what do you think is the logic or the basis on which how much money is required in the economy is determined by the RBI? So I have got a couple of answers. Archana has said based on our reserves. Sri Lakshmi has answered. Sri Lakshmi, SIA TVM, right? Your no. Okay, Bangalore. Okay, fine. It's not entered. That's right. Okay. So Sri Lakshmi says depending on the requirement, which is my question, how much is required? So your answer is depends on how much is required. So, but she has added another point, depending on inflation, deflation, and all those. Mohammed Sadiq says based on GDP and inflation. Very good. Then based on essential needs of a family. Very good. Money needed for people to buy produced goods. Perfect. So this logic I really like. Rahul has given a logic. So how much ever money people need, okay, how much ever money people need to buy the goods and services that are there in the economy. Why do people need money? What is the function of money? The first function we said is as a medium of exchange. That is the main reason why people require money. Okay, to buy things. So how much ever goods and services that are there in the economy, that much amount of money has to be there in the hands of the people. Without that, it is not possible to buy those goods and services. So the question is, what is the total value of all final goods and services that is to be consumed, that is available in the economy? We simply say whatever is the GDP of the country, that is the amount of money that is required, because that value of goods and services have been produced. Now, if those goods and services have to be consumed, people need that much amount of money. So total money in the economy is not based on reserves anymore. We followed a reserve system. Remember, full reserve system, partial proportional reserve system, and then minimum reserve system. Now we are in minimum reserve system, where how much reserve we have and how much money we have is not linked at all. A fixed amount of reserve is kept, and we'll keep printing as much money as required. But how much is required? Whatever is the goods and services available in the economy, that much money is required. In other words, we can simply say is equal to quantity into price. Okay, just keep this in mind. This is the formula for GDP. We have already seen this in the first chapter. GDP is equal to Q into P, quantity into price. Okay, I'm going to the next page. Assume that Currently Q into P is equal to GDP, right? And I told you that much amount of money is what is there in the economy. So this is money supply. MS, I'm referring to money supply. Okay. Let us say 10 pens are to be produced. Okay. Standard example that I use. 10 rupees they are sold at. GDP of the country is 100. GDP of the country is 100. Okay. Now, every year, every next year, every subsequent year, the government wants to increase the GDP. Is it true or not? If it's true, you have to tell me why. Why do you think the government wants to increase the GDP of the country? Give me the answer. Why does the government, why do we require the GDP of the country to increase? Everyone says GDP has to increase, 6% growth, 8% growth, 10% growth. Why? Rahul says it increases employment, standard of living and all those. Maybe. Increases the purchasing power of the Indian. That is if income is generated. But I am asking, when we say GDP has to increase, why? So there is one person, Tanuja has given me an answer. Tanuja says because of the increasing demands of the people. Because people are continuously demanding more and more. That is the reason why our GDP also has to increase. Not because people want to have a better standard of living. That is true. Better standard of living what means what? People are demanding more things. People who are having no car now want a car. People who are having no motorbike now want a motorbike. People who have one car want two cars for convenience. One person goes this way, one person goes that way. So they need two separate cars to go. Okay. So all these are the demands of the people that comes. Okay. Yeah. Kishore says to keep the people motivated to compensate the hiked prices. Now that I don't quite agree with. If you listen to this entire explanation, a lot of things that your understanding of economy will change a little, will change slightly. You will understand why is there increase in the price of a product in the first place. You would think because price is increasing, you are getting more money in your hand in salary. That is not true. You will see now. Okay. So now, because see, if you are living in a country where their people require only 10 pens or 10 products, whatever, if that is all they require, next year they are not going to ask for anything more, then the GDP of the country need not increase. There is no harm if the GDP of the country doesn't increase. People are happy with what they have. Okay. So the old way of living, have a little, whatever you have, you are happy with that. If you have that sort of a lifestyle, GDP need not increase. But the demands of the people are increasing. Maybe they want to improve their standard of living, or very simply, the population of the country definitely increases from year to year. When the population increases, obviously the demands of the people will increase. Right? That is the basic point here. Because the population keeps on increasing, now the government wants to increase the GDP, but truly what the government wants is not an increase in GDP. Truly what the government wants is an increase in the quantity of production. Or let's say instead of 12, let me take a different number. Quantity of production, 15. The government doesn't necessarily want the GDP to increase. The government wants the quantity produced to increase. But we would have already seen in the first chapter, government cannot measure quantity produced alone. Why so? Because imagine a scenario, two firms are there, firm A, firm B. Firm A is only producing one car in a year. Firm B is producing 5 cars in a year. Which is contributing more to the economy? On the face of it, we look and say firm B is contributing more. But what if this one car is worth 50 lakhs and this 5 car is worth 5 lakhs each? Which means it is contributing only 25 lakhs. This one is contributing 50 lakhs to the economy, right? So when I say it is contributing 50 lakhs, people who are working on creating this one car are maybe getting a higher salary because this is a very unique car. Maybe we are talking about a BMW here. We are talking about a Maruti here. Maruti Suzuki car over here. So the people who work in BMW are going to get a higher salary, whereas people who work in Maruti are going to get a comparatively lesser salary for doing a similar job, because this is a more specialized job. So if you simply look at the quantity that is produced, you will think B is contributing more to the economy. But only when you look at the price factor also, you get to understand the contribution of BMW is greater than the contribution of production of 5 Marutis. Okay, which is why we cannot simply look at the quantity produced, we need the price also. Okay, so which is why the government wants to increase the quantity produced from 10 to 15, but they will not simply say 10 to 15. They'll say the price also matters. They'll say we need to increase our GDP from 100 to 150. Okay, so now we ask number one reason. Why is there an increase in the quantity of money in the economy? First one, to increase the quantity produced. If 100 rupees is the GDP, how much will be the money supply in the economy? Rupees 100. With 100 rupees available, and you already saw the circular flow of income in the first chapter. 100 rupees is there in the hands of the business, it goes into the hands of the household as factor income, it comes back into the hands of the business as consumption expenditure. So only the 100 rupees will keep getting circulated. Okay, now with 100 rupees in the economy, is it possible to produce 15 cars or 15 pens or whatever, 15 quantity? No, this money is sufficient to produce only 10. So in order to produce 5 more, you need 50 rupees more. So 50 rupees will be increased in order to increase quantity of production. That is the first reason. So our heading here is determination of quantity of money. Our heading here is determination of quantity of money. What is the factor? What is the factor which determines how much money is there? To increase. How much ever is the targeted increase of quantity produced. We want to produce 5 more, 50 rupees has to be increased. We want to produce 6 more, 60 rupees has to be increased. New 60 rupees has to be brought into the economy. Okay, so this explains why 50 rupees is getting added to the economy. Existing 100 rupees plus another 50 rupees. Okay, but the story doesn't end here. The story is only just beginning. Okay, what do I mean by that? Let us say you are the producer of these pens. Let us say you are the one who's producing these pens. The government cannot come and force you to produce 5 more, because we are living in a country where the government cannot come and force you to do anything. The government can only say, we would ideally want you to produce some more. You might say, no, I am not interested. I don't want to expand my business. I am happy with this. I don't want to hire more people. I don't want to buy new machinery. I'm happy with the profit that I'm having. It's a logical argument for any business to take. Businesses don't always want to expand. Maybe I'm content with the small level of business that I have. If I open more branches, if I open more factories, I need to hire more people to manage. My workload increases. I may not want to. Okay, so the government wants the quantity produced to increase. So in order to do that, the government has to give some incentive to the producers. The government cannot force, in a country like ours, democratic country like ours, the government cannot force the producers to produce more. The government can only incentivize producers to produce more. What is the incentive for any producer? Can you send me the answer? For any producer, what motivates them to produce more? Waiting for at least one person to answer. Vamshi, not quite. Yes. Ragul, correct. Mohammad Sadiq, correct. What motivates a producer to produce more? Simple answer is more profit. They don't care if there is a higher demand and all this. They would want the higher demand, but the government is telling them there will be higher demand. That is why I want you to produce. The company says, if I produce 15 products and I'm selling it at the same 150 rupees, I'm not getting anything extra. Earlier I produced 10, I got 100. Now I produce 15, I'm getting 150. But to produce this extra 15, I need to hire new people. I need to hire new machinery. There is a lot of initial investment that goes in. That may not be very profitable for me. So the government says, okay, I will allow you to sell the product at a higher price. The government says, you keep producing the goods at 10 rupees, but I'll allow you to sell the product at a higher price. Okay. So the government says, I'll allow you to sell the same 15 goods, all 15 goods at 12 rupees instead of 10 rupees, so that you can get an additional profit of 30 rupees. If the price of the product doesn't increase, the producer may not even produce. So earlier someone answered that to compensate the people, to keep the people motivated to compensate the hiked price. That is not the reason why more is produced. The reason why the price increase itself is because more has to be produced. To incentivize the producers to produce more, the government is saying, okay, we will allow you to increase the price of the product. But simply, we cannot just increase the price of the product and expect people to buy. Because if the price of a product is increased, the people have to be given that money for them to go and buy things. Correct? Because if people don't have the money, and if the price of the product increases, how will the people buy the product? They will not be buying the product. Last year, something cost 10 rupees. This year, if it's costing higher than that, people will think, oh, it's becoming costly, I'll not buy. At what point will people feel it's okay, even if the cost increases, I'll buy? When people have more money in their hands. So there is an additional money which is printed of 30 rupees in this case by the government to increase the price of the product. Government wants the price of the product to rise, for which the government gives 30 rupees into the prints 30 rupees and brings it into the economy. Now, how does it reach the hands of the people? Does the government come and give directly money into the hands of the people? No. Every company at the end of a year, they give something called as an increment. They give something called as an increment. What is an increment? For doing the same job which we are doing last year, you are going to be paid higher. Okay, for if you are someone who is familiar with how government offices work, there is something called as dearness allowance. What is dearness allowance? To account for the increased prices in the economy, more money is given into your hands. That is how we understand it. We understand it saying prices have increased, so we are given more money. That is not the reality. If they increase the price and if we don't get more money, we will not go and buy the products. So they are increasing the price with the hope that more money will be given into your hands and you will go and buy. Okay, so in a way, they're increasing the price and giving you money so that you spend the extra money on the same products. Okay, that is the idea behind giving you increment. And I am not talking about promotion. Not everyone gets promotion. Promotion is a whole different thing in a firm. If you are working in a firm just for doing the same job which you did last year, this year you will be given a slightly higher percentage of income. Maybe 6% more or 7% more or 10% more, depending on the firm that you're working for. Okay, so that is what we call as an increment. Why is that increment done? To increase the price of the product. More money in your hands, you will be more than willing to go and buy things. Okay, imagine this. Earlier, in a previous scenario, you have one mobile phone in your hand. You have one mobile phone in your hand. Now, if you have more money in your hand, initially you will think I need a mobile phone for communication. That's all. But when you have more money in your hand, you might now think, okay, I don't mind having one more mobile phone just for the purpose of gaming. Okay, or I'm not happy with this version of a phone, I need a newer phone. All these thoughts start coming into your head only when you have extra money. And how do they bring in the thought into your mind? By giving you an increment. So even before increment comes into your hand, you have already planned for how to spend it. This is how most households are. Even before the money reaches your hand, you know that there is going to be some extra money. You have already planned an expenditure for that money. That is how it happens. So two reasons which determine how much money should be there in the economy: how much more goods are going to be produced, how much more is the price of the product going to be increased to. Depending on that, the government will or the RBI will bring in money into circulation. These are two factors which determine how much money should be there in the economy. Whatever is the targeted GDP growth of the country, a corresponding percentage of that percentage of money has to be brought into the economy for circulation. Is this clear? Is this clear? Is there any question now on this? Okay, perfect. There is one more reason which necessitates more money to be printed. You have written two reasons. One is quantity, to increase the quantity of production. Two, to increase the price of the product. There is a third reason why the money supply in the economy increases. It is not necessarily under the control of the government. This third reason. Okay. We are all familiar with the concept of trade. We have learned a little bit about it in the circular flow of income concept. There is something called as an external sector. There is an export, there is an import that happens. Subsequently, we learn more about remittances that come in, foreign direct investment that comes in, and all those we learn about it. But for the sake of just simple understanding, let's look at the external sector as inflow of foreign currency and outflow of foreign currency. Whatever be the reason, it could be export, it could be import, it could be loan, it could be investment, it could be remittance, it could be payment, whatever. Okay. If there is excess inflow of foreign currency, you require more money. Look at this. There is 100 rupees in the economy, let's say. Okay. A foreigner brings some, let's say $1 is equal to 1 rupee. Assume $1 is equal to 1 rupee. Okay. 100 rupees is there in the economy. In addition to that, now a foreigner brings in $10 into the economy. A foreigner says, I am going to bring in $10 into the economy for investment purpose. For investment. Or we have sold some commodity and earned $10 extra, more than what is required. Okay. So what will happen? $10 cannot be used inside the Indian economy. You know it is not legal tender in India, right? Dollar is not legal tender in India. It is not even fiat money in India, because it is not the Indian government who is authorizing that. You cannot take a dollar bill and go and buy things from a store. So what do you have to do? You have to take a dollar to a bank. A bank has something called as a forex division, and you go to the bank and say, here is $10, exchange it for Indian rupees, and you will ask for 10 rupees. Already 100 rupees is in circulation in the economy. This extra $10 which is coming in is necessitating 10 more rupees. Okay, is necessitating 10 more rupees. So you will now have a total of 110 rupees. Now assume $10 is coming into the economy, but $5 is leaving Indian economy. Let's say you are buying some goods. Let's say this is through export. Through export, some Indian businessman is earning $10, but through import, for imports we'll have to pay in dollars, right? Through import, we are paying $5 or $3, which means we are going, giving Indian currency to a bank and getting $5 and buying some commodity using that, which means what? There is an excess of $5 in the economy, and going by this particular exchange rate, $1 is equal to 1 rupee, there is an excess of rupees 5 in the economy, which means that the money increase is to 105. So which is why I'm saying, if there is an excess inflow, what is excess inflow? In this case, $10 comes in, but $5 goes out. How much is excess? $5 is excess. And whatever is $5 equal to in terms of rupees. Here I took $1 is equal to 1 rupee. But if you look at the reality, $1 is equal to, let's say, 75 rupees. Then multiply it by 5. Okay, which will be what? 150, 300, 4, 300, 375 if I'm not wrong. Okay. Yeah, so that much amount of rupees extra has to be there going by the current exchange rate. I'm just taking for simplicity $1 is equal to 1 rupee. So $5 extra, 5 rupees extra has to be printed. So to accommodate the excess inflow of foreign currency, also the RBI would be necessitated to print currency. However, this is not a good scenario to be in. Why? Because the GDP of how much is the money in circulation? Initial money in circulation is 100 rupees. Why is 100 rupees there? Because that is the GDP of the country. That is how much goods and services are there in the country. If the GDP of the country is 100, but there is 105 rupees in the economy, what will happen? More money, less goods. People will start paying more money to buy the same existing goods in the economy. Okay? People will buy People will start, they have more money, they'll go and they'll be willing to pay more. See, why are you, let's say you bought a chocolate, dairy milk for say 5 rupees. Okay, you bought a dairy milk for 5. Dairy milk is not a great example, because what they are doing is they are not increasing the price of the product, instead they are decreasing the size of dairy milk. You know that, right? They are decreasing the size of the chocolate, so that's not a very good example. Let's say a pen, you bought this pen, let's say 2 years ago at 10 rupees. Now they are increasing the price of the pen from 10 to 15 rupees. In spite of that, why are you willing to buy? Because your income has increased over the last 2 years. Your income has increased and you can afford to pay. Now if the money supply increases to 105, but the quantity of pens available, or let's say instead of 105 for convenience, let's take 150, but the quantity of goods available is only 10. Earlier, whatever you were buying for 10 rupees, now you will be willing to buy for 150 rupees or 15 rupees per pen. Earlier, whatever you were willing to buy for 10 rupees, now you will buy for 15 rupees. Why? Because you have the extra money. We will learn more about this concept. This concept is what we call as inflation. We'll learn more about this concept in a subsequent class. But please note here, excess inflow of foreign currency, this could lead to inflation. Just put a note there somewhere. We will learn about inflation later. This could lead to inflation. So generally what happens, if there is excess money, government or the RBI will do some measure to reduce the money supply that is there. So all those we learn when we get to measures to counter inflation. So this is an example of inflation. We will learn about the government measures when we learn about measures to control inflation. All that in the next chapter. Okay. So 3 reasons which determine how much money should be there in the economy. These are the 3 reasons. Number 1, to increase the quantity of production. Number 2, to increase the price of the product, which will motivate the producers to produce more. Okay. You give more money into the hands of the people. So with higher money, they'll go and demand more commodities. So that increases the price of the product. Okay. And finally, excess inflow of foreign currency. 3 reasons. If you have understood this concept, I'll move on to an even more interesting concept. This is one concept which is probably you knew it somewhere inside your mind. You knew everything that I'm teaching you, but you didn't know it as a concept. You understood it, but inside yourself, you did not quite realize that you had an understanding. That is what I have done. But something that you may not quite know about the economy is something that I'm going to teach now. Okay. I'll tell you the name of the concept after I have explained the concept itself. Let's say RBI prints rupees 100. Let's say RBI prints a new 100 rupee and brings it into the economy. Okay. Someone works hard for it and earns that money. So from the RBI, this money goes into the hands of a person called as, let's say, P. P is the name of a person. Let's call this person P1. I'll call other people as P2, P3, P. Now, the person P1 feels that this 100 rupees is extra. He doesn't require that money at this point of time. Okay. So what does P1 do with this money? P1 deposits this money in B1, where B1 stands for bank number 1. Okay. Deposits 100 rupees in bank 1. My question is, how much money does P1 have? The answer is rupees 100. P1 has rupees 100, which he has deposited in the bank. Now, why is the bank taking this money in the first place? Because the bank believes that it will give a loan to someone and make a money out of it. Why is P1 depositing in the bank instead of keeping it with himself? Because P1 thinks, the bank says, I'll give you some interest rate if you deposit the money. So B1 offers an interest for which P1 is going and depositing the money, but B1 will give this money as a loan to someone. Let's say it is given as a loan to X1. X1 is a businessman. Okay. X1 is a businessman. B1 cannot, for some reason, B1 is not allowed. RBI has a rule that every money that comes into a bank cannot be given as a loan. Some money needs to be kept as reserve. Only the remaining money can be given. So you will understand the reserve system also when we get to inflation. Some money needs to be kept as reserve. 10 rupees is to be kept as reserve in this case example, and 90 rupees is given as loan to X1. How much money does X1 own right now? Can someone answer? How much money does X1 own at this point of time? If you ask X1, how much money is your money? What will be the answer? X1. Some of you have answered 90. No, X1 does not own any money here. X1 has borrowed this money. The ownership of money is not with X1. This money, 90 rupees, which X1 has, is not X1's money. It is money which is borrowed. So X1 effectively does not own any money. X1 has borrowed that money. But why is X1 borrowing the money? What is the golden rule of borrowing? I told you this in public finance as well. What is the golden rule of borrowing? Never borrow for personal consumption purposes. Always borrow for investment purposes. So X1 being a businessman will invest it. When you say invest it, to produce something. When the production happens, it will be given as income to someone. What is the cost of production? Nothing but the income that is given to the various factors of production. That is what is cost of production, right? Factor income is nothing but the cost of production. So it is given as income into someone else's hand. Let's say P2 receives this as income and P2 now has 90 rupees. Now we ask a question, how much money does P2 own? Now you will say 90 rupees because P2, that 90 rupees is earned money, not borrowed money. That 90 rupees belongs to P2. But earlier with X1, it was borrowed money. Okay, I hope this is clear. But now comes the interesting aspect. How much money does P2 own? We will say 90 rupees. P2 owns. We still ask a question, how much money does P1 own? Do we say 0? No. P1 still owns 100 rupees. It is just in a bank. That's all. P1 owns 100 rupees, which is in a bank. So if you ask P1, how much money do you have? P1 will say, I have 100 rupees. Not with me in a bank, but I have 100 rupees. Let's say I am P1. Now I am P2 and you ask me the same question. I will say I have 90 rupees. RBI printed 100 rupees, but people believe they have 100 and 90 rupees. You understand? The same 100 rupees is now owned by two people. One person owns 100, one person owns 90. But there is only 100 rupees in the economy. Now let's expand this a little further. The same concept, I'm not going to go into the detail and explain. P2 doesn't require this money, puts in bank B2. 10 rupees is kept as reserve. 80 rupees will be given out. B2 gives it to X2 for business. So X2 does not own any money. X2 has borrowed the money, but X2 gives it as a wage to P3. Let's say P3 earns 80 rupees. She owns 80 rupees now. P3 owns 80 rupees now. Okay, I'm going to elaborate this even further. P3 deposits in a bank, B3. So she doesn't require the money right now. She deposits 80 rupees. 10 rupees is kept as reserve. 70 rupees comes out to X3. X3 uses it for further production, goes to P4. She has 70 rupees in her hand now. She owns 70 rupees. I'm going to do this one more time. She also doesn't require the money. All these are assumption that they don't require the money at this point. They could as well spend the money. If they spend the money, end of story. That's all. Nothing else will happen. But if they spend the money, that money will go into someone else's hand and they may deposit in a bank. Okay. So P4 doesn't require the money. P4 will spend it in a store. So it goes into the storekeeper's hand. Storekeeper may keep it in a bank. So ultimately, it is likely to go to a bank. So P4 goes to bank and 10 rupees is kept as reserve. 60 rupees comes out. X4. P5 owns 60 rupees. So P5 owns 60 rupees. This cycle will keep on continuing till there is no more money left to deposit. It's an endless cycle. Okay. Now look at it. How much money was printed in the economy? Rupees 100. How much money do people believe that they have in their hands? P1 believes there is 100 rupees in his hand. P2 believes there is 90 rupees in his hand. P3 believes there is 80 rupees in her hand. P4 believes there is 70 rupees in her hand, and P5 believes there is 60 rupees in his hand. You add it all together, you will get a value of 400. Let's say there are 5 people in this country. RBI printed 100 rupees, but these 5 people believe that they have rupees 400 in their hands. Which means what? They believe the purchasing power of all of them together is 400 rupees. Is it true? In reality, is it true? Can all of them go to the bank at the same time and get 400 rupees? No. If all of them go to the bank at the same time, the bank will never be able to give that money back. If all of them go to the bank at the same time, the bank will never be able to give back that money. So there is an assumption that I have money in the bank, that it is always there, that I can access it at any time. Because I have the confidence, I will not access it now. I will put money as a fixed deposit, let's say. For 1 year, I'm telling you, I'm getting into an understanding with the bank. I'll give you money for 1 year. I'll not come and ask for 1 year. You give me an interest rate. Saying, okay, bank is saying, okay, you are not going to come to me for 1 year. Let me use this money for other purposes. They give a loan to someone. They use it for some other purpose. Now that person owns the money. By the time 1 year later you come back, it is the responsibility of whoever borrowed money to give back the money to the bank. Okay, and then the bank will give it to you who deposited the money. This is the reason why if the one who borrowed doesn't repay the money, the entire system could collapse. You have heard of this problem called as non-performing assets, NPA, which is very frequently in the news. What is non-performing asset? A bank has given a loan, which is its asset. It is not able to recover the loan. Why is that a problem? If it is not able to recover, the bank will not be able to repay the customer who deposited money. The entire system will collapse. That is a problem with non-performing assets. Okay, so this is how the system works. This is how almost all the countries in the world work. This is how almost all the countries in the world work, where people believe that they have money. The reality is that much money is not there in the economy. It means the reality is that only a fraction of that money is physically available in the economy. The remaining is an illusion of the people. Now you say that you have earned, let's say you have earned 50,000 rupees this month. You deposit in a bank. You think that money is kept in some locker by the bank in physical form? No. When you go to the ATM and withdraw money, is it your own money that you're taking? No, it is common money. So based on a digital account that you have, they will give you some money. You do not have physical ownership over your money until you hold it in your hand or you keep it in a box in your house. Once you deposit in a bank, you don't have physical ownership of that money. Or you'll have to go to a bank locker and keep the money over there. Other than that, there is no physical ownership over money. There is only a conceptual or a digital ownership of that money. And it is not because of the computer system. Remember, this is not only because of the computer system. Even before computers came into existence, when it was just written books, ledgers, even then this is the concept. It is not just digital, it's just virtual. It is virtual, it is imaginary. That ownership of money is imaginary in nature. Okay, so this particular concept is what we call as money multiplication. RBI prints 100 rupees and brings it into the economy. That 100 rupees has the ability to perform the role of how much? In this case, it has the ability to perform the role of 400 rupees through this process of money multiplication. So which means that 100 rupees gives a purchasing power of 400 rupees to the people of the country. What is your purchasing power? Whatever money you have, that is your purchasing power, right? P1 believes he can buy for 100 rupees. P2 believes he can buy for 90 rupees. P3 believes she can buy for 80. P4 believes she can buy for 70. P5 believes he can buy for 60. They believe together they have the purchasing power of 400 rupees. But RBI has only physically printed 100 rupees. Okay. Take the most successful bank that you can think of in this country. Take the most successful bank. No NPA issues, nothing at all. Everything is proper, in good condition. Even that bank If all its customers, depositors go and ask for their money back at the same time, the bank will completely collapse. The bank cannot exist because this is how the banking system itself works. Okay, this is how the banking system itself works. Which is why recently, when there was a controversy about Punjab and Maharashtra Cooperative Bank, that bank got into a bit of trouble. Okay, or take Yes Bank. Yes Bank got into a bit of trouble. Immediately, RBI comes in, steps in, and very recently, I think it is Lakshmi Vilas Bank which was in trouble. So RBI puts a moratorium. What is moratorium? It's a simple word. It says restriction on regular activity. That is what is a moratorium. Restriction on regular activity. RBI says the customers of this bank, you cannot come and withdraw all your money now. We are going to put an upper limit of how much of your own money you can access. RBI says, see, we go and deposit money in a banking system with the belief that we can access our money at any time. But RBI is coming and telling us it is your money, but you cannot access it now. Why is the RBI doing it? Because RBI knows, see, if you have money in a bank and you hear some bad news about the bank, you are always under fear that the bank is going to collapse. What is your natural tendency? You will run to the bank and try to get all your money before the bank collapses. Correct? If everyone starts thinking along these lines, then the bank will definitely collapse. So which is why the RBI comes in and says, out of panic, you will come and demand money. I don't want to give room to that. Okay. If there is a genuine reason, I'll allow you to withdraw up to a certain amount. If you need more money, let's say you have some health issue or something like that, you need to withdraw money, you seek a special request from us. So you have to get a special permission from RBI, and then they'll allow you to access that money. It is your own money. But they don't want you to withdraw that money purely out of panic, because if everyone withdraws the money, the bank will definitely collapse, because this is how the entire banking system works. This is why the RBI will intervene and say, okay, now the bank is in some trouble, all of you will panic and get the money, no more money for you. It is your money, you will get it, but not now. Okay, so this is how the banking system works. This is a concept of money multiplication. Now think of this, link the two concepts that we have learned so far. How much money should be there in the economy? Whatever is the GDP of the country. Simple answer, whatever is the GDP of the country, QP. Okay, if let's say the government wants the GDP of the country to increase by 100 rupees, let's say government wants the GDP of the country to increase by 100, including the Q and P, the two reasons that I told you. Government wants a GDP to increase by 100 rupees. If the RBI, so let's say initially the GDP is 100 rupees, or let's say 200 rupees. This is the original GDP. The new GDP that we expect is 100 rupees more. The new GDP expected is rupees 300. This is the new GDP that we want, which means we are targeting an increase in GDP of 100 rupees. So if the RBI prints 100 rupees, what will happen? 100 rupees will give the people the belief that they have 400 rupees in their hands. Why 400 specifically? In this example, I've given you a multiplication of 4 times. Okay, the money is, because of this process, it is multiplying to 400 rupees. It could be, see, you ended at this stage, it will be 390, or not 390, sorry, 340. You ended at this stage, it will be 70 rupees lesser, 270. You take it one step further, it will be 450. It is 400 is not a fixed number. I'm just stopping it in this stage. Okay, people believe that they have 400 rupees, which means that people will demand for 400 rupees. Now what will happen? People believe they have 400 rupees in their hand if RBI prints 100 rupees. So if the government wants the GDP to increase by 100 rupees, they should not be printing 100 rupees. They should be printing, they should know how much is the multiplication happening by. In this case, the multiplication is happening by 4 times. So what they should do? They should print only 25 rupees, so that it will go into the banking system and multiply and become 100 rupees in the economy by the end of the year or during that period. Okay, so this is what the government will do. So it is a combination of these. How much is the money required in the economy? It is determined by the expected GDP, targeted GDP. But whatever is the targeted GDP, that much amount should not be printed. Why? Because money will multiply because of the banking system. Money will multiply. So it is very, very important for the government and the RBI to understand and to calculate one particular number, a number called as money multiplier. Money multiplier. We know that money is multiplying, but we need to find out by how much is it multiplying. In this example, 100 is multiplying to 400. So 400 divided by 100 is equal to 4. So we say money multiplier has a value of 4. But it is just an example that we took. It could be 3.5, it could be 4.5, it could be 6, it could be 8, it could be 2. We don't know. What determines the value of the money multiplier? You tell me. What determines the value of money multiplier? You tell me. What determines the value of the money multiplier? You tell me, because our next topic is based on that. Sri Lakshmi, it's not the number of times the money is moving hands. I earn the money, I give it to you, you give me a service, you give it to someone else, that is not going to lead to money multiplication. Because let's say you are a shopkeeper, I buy things from you, I give you the money, now I and you don't own the money at the same time. Initially, I owned the money, I bought something from you, so I gave you money. So now only you own the money. Their multiplication is not happening. It is not by change of hands. It is by one particular activity that the money is multiplying. Yes, Raj, you are close, but you need to be more specific. Where you have to answer. Correct. So Akash has given me the right answer. Karan has given me the right answer. What determines the money multiplier? The banking habits of the people. Where is the money multiplication happening? It is from the bank that the money is multiplying. If there is no banking system, if there is no concept of banking, there is no multiplication of money. Because you have a bank, you deposit money in the bank. You believe your money is safe there. You believe at any point of time you can take the money and use it for your consumption purpose. You own that money. And because the bank is giving it as a loan to someone and that person is using it to pay income of someone, that person also has the money. Now, two people are owning the money at the same time only because a bank exists. So instead of depositing the entire 100 rupees, if I deposit only 50 rupees, then money multiplication will become half. Do you agree? Or half of less than half. So what determines the value of the money multiplier is the banking habits of the people. The better the banking habits of the people, the more people who depend on banks, the more is likely to be the money multiplication in the country. The more people's desire to keep the money with themselves, the more people's tendency to just spend on their needs, consumption needs, the lesser will be the money multiplication. So someone had answered savings. Raj answered savings. Savings is correct, Raj, but savings where is also very important. If you keep it with yourself, also it is saving. Okay, but in economic theory, savings means in the banking. So I will agree to your answer. Raj answered saying savings. So yes, savings, but savings in a bank is what is leading to money multiplication. By when I say bank over here, I'm referring to any organization where there is deposit of money and there is lending activity happening. Wherever there is borrowing and lending activity happening. Okay. So it is very, very essential for us to learn in order to understand money multiplication, in order to calculate the value of the money multiplier. It is very, very important for us to understand the concept of banking. Now take a look at the index that I have given before this chapter. Tell me what is the next topic that we are going to learn. Correct. The next topic itself is banking. Bank and its features. So you would have said, you would have read monetary aggregates. Monetary aggregates is the topic, but under it, what are we going to learn? We are going to take a complete detour from money. We are going to learn about certain features of banking, certain types of accounts. That is what I would have given you. The larger heading is monetary aggregates, but even monetary aggregates, we ask a question, why are we learning? Our entire purpose here is to learn the concept of money multiplication. If we understand money multiplication, if we know how to calculate the value of the money multiplier, our job is done. We don't need to know anything more. But to understand money multiplier, we need to understand the banking system. So we are going to take a detour and we are going to learn a little bit about banking system. Okay. Please note, there is a separate chapter called as banking, where we learn about the chronology of banking in India, the NPA trouble and all those we'll learn. Okay. There we will not learn about what is the function of a bank. So this is the topic where we'll be learning about functions of a bank. Okay. What is a bank? How does it function and all those. Okay. So, some basic idea about the banking system. Okay. There is something called as RBI Act 1934. I told you about this already when I told you about RBI. So it is based on this RBI Act. RBI Act has a lot of schedules in it. Schedules means a lot of rules inside it. Those are called as schedules. Okay, we have the constitution. In addition to the articles, there are also certain schedules, right? Schedules means different segments. Schedule 1, Schedule 2, Schedule 3. Similarly, for under the RBI Act also there are schedules. Okay, those schedules give an idea of who all can be a bank, what are the requirements to set up a bank, and what are the conditions to be followed if a bank has to function in the country. Because RBI is the regulator, RBI Act gives that information. There is also one more act called as the Banking Regulation Act. If I'm not wrong, the year is 1949, but this year I'm not absolutely sure about, but I think it is 1949. You can do a quick check and you can adjust or edit it accordingly. I think it's 1949. There is something called as Banking Regulation Act, which again gives certain conditions to set up a bank. These two are the basis of the banking system in India. These two acts determine what are the conditions of a bank, what are the rules a bank has to follow, and all those things. Okay, so that is one basic idea about the banking system in India, how it works, what is the role of a bank, who can be a bank, who can set up a bank, who cannot set up a bank. Recently you would have seen a news about corporates being given permission to set up a bank. It is the Banking Regulation Act which lays a condition that corporates cannot own a bank. The Banking Regulation Act, they have their own reasons. So now if that amendment has to be made, this act has to be amended and a new rule has to be brought in that corporates can also own a bank. Okay, the reason why corporates cannot own a bank so far is that if you are a business person and you own a bank, who will you give a loan to? You will take deposits and give a loan to yourself, right? You will not be very judicious about the loan that you give. Even if you are owning a failing business, you will give a loan to yourself because you will always believe in your business, right? That is the reason why corporates cannot own a bank so far. Now the RBI is thinking of bringing banking or giving ownership of banks to corporates. We'll have to wait and see what is happening. Anyway, all those rules are under one of these. Now, if a bank is set up based on RBI Act, based on the conditions in an RBI Act, it is a bank set up as per a schedule in the RBI. I told you there are schedules in the RBI Act. It is a bank which is set up under the schedule of RBI Act. So we call those banks to be scheduled banks. Scheduled banks are banks which are set up under the schedule, under a schedule, Schedule 2 of the RBI Act. But within scheduled banks, there are banks which perform two major types of functions. There are commercial banks and there are cooperative banks. There are commercial banks and cooperative banks. So you would often come across a news saying scheduled commercial banks. You would come across your SBI, Punjab National Bank, ICICI, Federal Bank, or Standard Chartered Bank. All these are examples of scheduled commercial banks. What do we mean by commercial? Their objective is profit. What is a scheduled cooperative bank? A scheduled cooperative bank is a bank whose motive is welfare of the people who form that cooperative. What is a cooperative? A group of people come together to form an organization, right? So, welfare of the cooperative. And who's a cooperative? Everyone who deposits money is part of that cooperative. Everyone who borrows money is also part of that cooperative. So their own welfare is their primary concern. Welfare of the people, of certain people, is their concern, of their members. So they have a banking system over there. Okay, whoever lends and borrows, they cumulatively own that bank. Here it is a separate entity who owns with the profit motive. So that is scheduled commercial bank, SCB, or scheduled cooperative bank. In India, there are some very few 3 or 4 banks in the entire country which are non-scheduled banks, which means actually they were set up much before even RBI came into existence, and they are very small entities, just one bank in some corner of a village, some really old bank which is still in existence, which is probably run by a family or something like that. The government has given the permission to do that. Those are the only non-scheduled banks. We need not learn about non-scheduled banks. What is important for us is to learn about the scheduled banks, because every rule that we say is applicable to banks, it is applicable only if it is a scheduled bank. Okay, so just learn about scheduled banks, but know that there is a concept called as non-scheduled banks. If they are not created as per the RBI Act, they are non-scheduled banks. Okay, then there are also other types of banks like regional rural banks, regional rural banks. Those have specific objectives, like they have to cater to the rural region and all those. Most of their branches are going to be in rural areas. RRB we call them. That's also a type of specialized type of banking system, okay, which is also a scheduled bank. Then currently we have other banks like Payments Bank. Then we have another bank called as Small Finance Bank. These two banks, Payments Bank and Small Finance Banks, these are very recent additions to the banking system. Very recently, just a couple of years ago, RBI introduced saying that, see, earlier there was, even today, there is a rule that to even start a bank, you need 500 crores. 500 crores as initial capital, you need to start a bank. So everyone cannot start a bank. So they said, okay, we are going to allow a bank to be started even with as less as 200 crores, which is less than half the money. But you have to follow certain conditions. Most of your branches have to be in particular areas. You have to give most of your loans to particular areas, right? Those sort of conditions that are there. So these two are examples of specialized banks or differentiated banks. These two are examples of specialized or differentiated banks. They are banks, but they are unique. They do not have the normal rules that are applicable to other banks. There are special rules for them. Okay. And with respect to governance of banks, commercial banks are entirely regulated by the schedule of RBI. But cooperative banks, they are partly regulated by RBI, but they are also partly regulated by the state government. The reason for that is that cooperative banks are governed by 3 rules. There is RBI Act, there is Banking Regulations Act, and then there is something called as Cooperative Societies Act. So 3 rules govern them. As per the Cooperative Societies Act, the state also has some control over them. Do you remember during demonetization, cooperative banks were not allowed to convert cash. Only scheduled commercial banks were allowed to, because cooperative banks were not entirely under the control of RBI. RBI was not able to see all the transactions that were happening there. So they said no transfer of money, no exchange of money from cooperative banks. Although they are scheduled in nature, they are governed by multiple entities. RBI has some level of governance, government has some level of governance, state government. Okay. So this is the banking system. This is an overview of the banking system. Let's look at the function of a banking system. Number one, primary function. What is the primary role of any bank? A bank is set up so that it can accept deposits, it can give out loans. This process is what we call as financial. What is the bank acting as? The bank is acting as an intermediary between a person who has excess money and a person who is falling short of money. So financial intermediation. Financial intermediation. Sarah says it is 1949. Thank you, Sarah. The Banking Regulation Act is indeed 1949. Thank you for that update. Okay. So financial intermediation is their primary function. This is what we are going to elaborate on, but I'll give you about the tell you about the second and third also. So there is something called as the secondary function. See, do you remember the classification of sectors in the country into primary and secondary, primary, secondary, and tertiary? When we say primary and secondary, what differentiates secondary from primary? Secondary cannot exist without the primary being primary existing. Okay, to create the output that is there in the secondary sector, you need input from the primary, and the output that is generated in the secondary is also naturally not available. That is with respect to the production. Here, when we say secondary function, is function that comes into existence because the primary function exists. What is primary function? Accepting deposits. What is derived out of that as a secondary function? We say because the deposit is there, I'll allow you to withdraw cash. You can go to the ATM and withdraw cash. You can use your debit card and swipe it in places. You can issue checkbook. You can issue a check. You can issue we'll create a DD for you. Okay. The ability, the function which allows the people, the depositors and the lenders to access the money from the bank, we call it as the payments services. Payment services. Okay, it has other names also. You can call it as the payments and settlement system, payments and settlement system, or payments and clearance system. Payments and settlement system or payments and clearance system. What is it? Let's say you are sitting at your home, you're taking your checkbook and you're issuing a check saying, okay, this check is for 50,000 rupees. You're giving it to some individual. This individual is taking this blank piece of paper, not blank piece of paper, this just a piece of paper with your signature and an amount saying 50,000 rupees. This person is going to the bank. So you are trying to pay. The bank takes a look at it. The bank says, okay, this is a signature in our record. This person has this much amount of money. Okay, fine. Take this 50,000 rupees. You are issuing a declaration, you are issuing an order, and the bank is clearing it for you, or the bank is settling it on your behalf. So payment services or payment and settlement system or payment and clearance system. You go to a store, you buy some commodity, you don't have cash with you. You swipe a card. What is happening? You swipe a card, the request goes to the bank. The bank says, is it really you? Confirm that it is you. So you type in your PIN number, ATM PIN or whatever, and you confirm that it is indeed me. I am the one who's asking you to give the money. Okay. So you make a request, the bank clears the request on your behalf. Payment and clearance system or payments and settlement system. That is what we call as the payment services. And this exists because you have an account with the bank. Because you have deposited money or you have borrowed money from the bank, this service exists. That is why it is a secondary function. And we have something called as not tertiary. Here we are going to use a different name, subsidiary function. See, it is a subsidiary function and not a tertiary function. Why? Because this function is not dependent on primary or secondary. Whether you have an account with the bank or not, the bank performs these functions. Okay, which is what sometimes the bank provides you insurance. The bank says, okay, your account and all those is there, but we also provide insurance. Do you want some insurance? Maybe you can insure your account, or you can insure your life, you can insure your car. We'll provide you all these things. The bank says, we have a locker facility. Even if you don't have an account here, no problem. Just open a locker with us. You can deposit your valuable jewels here. Why is the bank able to do this? The bank is anyway dealing with a lot of money, security system and all those. Now the bank is thinking, why use it only for banking activities? Why not use it for other financial activities and make some profit out of it? And the government and the RBI has given permission for that also. This is what we call as financial services. These are non-banking services offered by bank. Non-banking services offered by bank. The bank says, on your behalf, we can regularly pay your electricity bill. They may give you an offer like that, or on your behalf, or you can use our portal to file your income tax returns. All those are extra financial services provided by them. You may have an account or you may not have an account. You can still use these. Nowadays, you know about this concept called as FASTag, right? You go in a car, there is a tag called as FASTag. To pass toll plazas and all those, you need that FASTag. This FASTag is again provided by a bank, right? It is not banking function. You need not even have an account with that bank, but you can create, they'll provide you that. All these are examples of financial services provided by banks. All right. So we are going to elaborate a little bit on this. We are not going to study any further of the secondary and subsidiary function. We are going to elaborate on the primary function. Just one more point before I go further. See, this financial services, the bank is entering someone else's territory and doing their work. For example, insurance is provided by insurance companies, but the bank is also becoming a competitor over there. Okay. Interestingly, we think financial intermediation is something that only banks will do. No. In addition to banks, there are other entities which do financial intermediation as well. I do probably heard of non-banking financial companies, NBFCs. If you go to buy a car from a showroom and you ask them about the loan facility, can I get an EMI facility? They'll say, we do have EMI facility. And you take a list of the companies which is providing that EMI, banks might be there, but you will find that there are other entities like Sundaram Finance or Muthoot Finance or some corporation like that. Okay, DBL Finance or this name or that name. They are providing financial intermediation also. Okay, the bank has competition here. The bank itself is a competition here, but there is one feature which is unique to a bank. Only a bank can provide, no one else can provide, which is payment services. In India, only a bank has the right to issue debit card. Only a bank has the right to issue a credit card. Only a bank has an right to issue demand drafts or check. All these facilities, which we call as payment services, are exclusive functions of a bank. No one else can do it. Someone is asking, Rahul is asking, does UPI service come under subsidiary? UPI, you mean Unified Payments Interface, the BEAM and UPI and all those? That is not a service provided by the bank. That is a service provided by, I think if I'm not wrong, NPCI, National Payments Corporation of India. They provide that service. A bank may say, okay, I'll avail of the service. So let my account holders be able to use the service. It is not a service provided by a bank at all. It is a service provided by someone else. Okay, so we are going to go slightly deeper into the primary function, which is financial intermediation. Two aspects from a bank's perspective. Everything I'm saying is from a bank's perspective, not from the people's perspective. Okay, from the bank's perspective, they borrow money and they lend money. When they borrow money, we call it as deposit from our side. So generally, households deposit money and businesses borrow money. Households deposit money, businesses borrow money. But from a bank's perspective, bank borrows money from the household, bank lends money to businesses. From a bank's perspective, think of yourself as a bank. You borrow money from people. They'll call it as deposit. They will deposit money with you. But from your perspective, you are borrowing that money. Why? One, you have to give it back. Two, you have to give them an interest. Okay, so the bank is borrowing money from the people and the bank is giving a loan to businesses for them to go ahead and do their business. So that is from a bank's perspective. So which is the asset of a bank and which is the liability of a bank? You tell me. What is this deposit or borrowing that is happening? Deposits, we can call this as deposits also if you want. Which of these is an asset? Which of these is a liability from a bank's perspective? From a bank's perspective, deposits are very good. Which is a liability? Deposits are the liability of the bank. What is a liability? Liability is a compulsion for them to repay. When they get that money, it is not their own money. Okay, and when they give out a loan, not only will that money come back, they'll also earn an interest out of it. So it is a profit making endeavor. Giving out loans becomes assets. Okay, so can we sort of agree that the moment money comes into a bank, the bank will definitely try to give a loan out of it? Can we conclude? Why can we conclude that? Because if the bank cannot give it out as loan, the bank will lose money because it has to give an interest out of it. So there are two possibilities. We can measure how much money is there in the hands of the people. When we say money multiplication, we can either look at how much money is there in the hands of the people, but it is very difficult to get that information. People may not always reveal how much money is there in their hands. If some government authority comes into your home and asks how much money do you have in your account, how much money do you have in your hand right now, are you going to tell them the truth? Obviously not. So even in your school days, I'm sure you would have been asked in your school calendar, parents' income. You know how many of you told the truth and how many of you just gave a random number. Okay, so people don't reveal. When the census information is taken, people don't give the truth with respect to how much money is there in their hands. People are not comfortable revealing their income and their overall assets. People who have less claim to have more. People who have a lot claim to have lesser for their own reasons. Okay, so we cannot get to know how much money is there in the system from this side. There is only one way where we can find out how much money is there in the system. The RBI controls the banking system. The banks work under the RBI. So if the RBI says you will have to give a report of how much money is coming into your account, into your hands, which is how much money is deposited into the bank, then the bank has to give that information. That will give a clear idea to the RBI as to how much money is coming into the bank, because when it comes, it will automatically go and multiply, because the RBI, the banks will find a way to lend the money to the people. Otherwise they cannot exist, they cannot survive. Okay, so what we are going to do is, we are not going to go much into the assets part, but we are going to go into the liabilities part. Okay, we are going to go and learn a little more about the liabilities. I'll give you some common examples of assets. Assets means the loans, various types of loans. So you can write a list of various types of assets. So types of assets, you can put the next heading as, and you can write housing loan, business loan. I'm not writing in any particular order, just random. Then what do we have? Housing loan, business loan, education loan, agricultural loan. Then we have government loan, which is something you may not be quite familiar with. What is government loan? Bank giving a loan to the government means what? We have not learnt in detail. You have heard of G-Secs, right? G-Secs and T-bills. I told you I'll give you more details about that. So when you lend money, the government gives you G-Sec. So by that is what we call as government loan. We will come back to this a little later when we learn banking itself. In banking, when we learn about something called as capital adequacy ratio, we'll come back to this. But what is our current focus is going to be these liabilities. Okay. Liabilities can also be called as deposits. It's a liability from the perspective of bank. It is a deposit from the perspective of the household. Okay. Now we will be learning all the concepts primarily from the perspective of bank when we learn about multiplication. But we are more familiar with the name of deposits. You would have heard of savings deposit account, fixed deposit account. All these are easier understood in that name. So I am going to use that. So types of deposit accounts in bank. Notice this deposit account is nothing but a liability. This will take me about 15 minutes to complete. Do you want a break before that, or can I continue? Do you want just a 2-minute break? Not a lot, not a big break, 2 or 3 minute break, which will invariably extend to 5. Do you want that, or do I proceed? Okay, someone is yelling at me saying, yes, sir, break is needed in all caps. I understand your exasperation. Don't worry, don't yell at me. But thankfully for me, there is at least one person who's a participant who's saying, no, sir, no need for a break, you can proceed. But the others will kill me if I don't give a break. So it feels good to read your message. I'll not name you because you will become the villain of the class. So I'm not naming you, but I'm happy inside that you don't need a break. We'll take anyway a 3-minute break. We'll come back at 3:35. So that will be a 3-minute break. Just relax. Raj, locker facility is an example, Raj. You're asking me examples for subsidiary function. Locker facility is an example. Or the bank offering to invest your money in some products like mutual funds or something. If they give something like that, that is an example. Investment in mutual funds, which banks sometimes provide, that's an example of subsidiary function. All right. All right, we'll continue. Okay, so we are going to divide this types of deposit accounts or types of liability of a banking system into two: the liabilities that are caused by a household, or the deposits by a household, and deposits by business. Because we are learning about the deposits, we'll also learn about deposits of NRI, which is not very relevant for our study, but we'll still go ahead and learn about it. Okay, so coming to household, they have first of all something called as savings deposit account. Okay, so why do people deposit their money in their account? If people need money for today's needs, people will not deposit money in their account. They know that they require the money for immediate transaction. People will deposit the money in a bank account only when they are unsure about when they'll require the money. They want to probably use the money tomorrow, 1 week later, 1 month later, 1 year later, whatever be the case. So people deposit the money in their account. So what people are essentially trying to do is they are trying to save their money for future. Okay, their future expenditure is uncertain, so they are saving that money. That is a savings deposit account. Okay, will it provide an interest? Definitely, because why are you going to the bank in the first place? Why not keep the money in the house itself? Because the bank is offering some level of interest to you. And how much interest will be provided by a bank? Anyone who's depositing it as savings account, savings deposit, cannot expect a huge benefit out of it. The whole idea behind this is, if you are buying a product today, and you're, instead of buying that product, you are putting the money in a bank account, 1 year later you should be in a position to buy that same product, which means that the value of your money should not be lost. Imagine you had put the money in your own, you had kept the money in your own house. You have 100 rupees, you keep it in your house. You keep it in your house. 1 year later, if you are trying to buy something, you may not be able to buy with that 100 rupees. Why? The price of the product would have gone up. This concept of inflation. Because of inflation, you will not be able to buy because the money available is not sufficient. So what the bank will do is, whatever is the rate of inflation, somewhere around that they'll provide an interest, so that 1 year later also you are able to buy the same product. So the interest rate associated with savings deposit is somewhere on the lines of inflation. Say inflation is 4%, the bank may provide 4.2, 4.25% or 3.75% or somewhere on those lines. That is what a savings deposit will provide. Okay, that is what is a savings deposit. Then we have, see, very key point with respect to savings deposit is, you can go and demand the money at any given point of time. You can go and demand the money at any given point of time. So we will also call it as demand deposits. Demand deposits. You can demand the money at any given point of time. So it is called as demand deposits. From a bank's perspective, you call it as demand liability of the banking system. So this demand deposit from the people's perspective, but from the bank's perspective, it is a demand liability. So this is from people's, depositors' perspective. This is from bank's perspective. Why am I telling you all this? Because you should be familiar with different usages, different ways of mentioning the same thing. In an exam, they don't always, UPC will not always stick to whatever is the conventional norm. They look at it from different perspectives and use words differently. So you should be familiar with that. So demand liability. Okay. Now we ask one more question. In a savings account, can you use every single amount that is, every single rupee that is there in a savings account? For example, you have, let's say, 30,000 rupees in your account. Can you use the entire 30,000 rupees? The bank may not quite agree. The bank may say, see, we are making some expenditure in maintaining your account. We are appointing people to monitor your needs. We are appointing a customer care executive for your purpose. There will be a bank coordinator for you. All these are expenditures for us. So we need to be sure that you will use the banking system. It should not be a case where you open a bank account and then you forget about it. You don't keep any money over there, because the moment you open a bank account, the bank has to maintain that bank account, for which it has to employ people, right? So the bank says, I need to be assured that you will consistently use your bank account. To ensure that you consistently use your bank account, the bank will say, keep a minimum balance in your account, so that you don't run away, that you will come back to your account at any given point of time. If you are living in urban areas, they may ask you to keep as high as 10,000 rupees as minimum balance in your account. Some banks ask for that. Some banks ask for only 5,000 rupees. If you are living in a rural area, they may ask as low as 2,000 rupees or 1,000 rupees or even 500 rupees in some case. Keep as a minimum balance. Okay, so there is also a minimum balance component of it. So within the savings deposit, there is also something called as time deposit. From a depositor's perspective, it is called as time liability. From a banker's perspective, what do we mean by time here? For some time, there is some time obligation associated with it. As long as you have the account, you cannot access that money. You should always retain that amount with the banking system itself. If 2,000 rupees is the minimum balance, then at any given point of time, 2,000 rupees has to be maintained in your account. Otherwise, they'll impose a fine on you. They'll impose a charge, penalty on you. Okay, so savings deposit itself is divided into two types. One is demand liability portion, one is time liability portion. Think of an example for time liability portion as the minimum deposit, minimum account balance that you have to maintain. That is an example of time liability portion. Okay, so any money which cannot be withdrawn for a specified period of time, for some period of time, which cannot be withdrawn on demand, any deposit which cannot be withdrawn on demand will be called as time liability. But there is one more term within time liability which I'll introduce you to now. But before I get there, is the concept of savings deposit clear? Now, if it is clear, I need to add one more point. There are specialized types of okay, just 1 second. Jawahar, Archana, I'll get back to your questions a little later because I'm in a flow. Sarah says there is some disturbance. Sarah, is it still there? Waiting for a response slightly. What sort of, is there anyone else who's feeling a disturbance in the background? Audio disturbance? Okay, I don't seem to get a response on that. Okay, as in there is, others are saying there is no disturbance. Okay, it is clear. Some, so Archana is saying yes sir. Does yes sir mean, okay, but it's mild. There is some, what sort of a disturbance is it? Because everything else is same here. Before the break, after the break, it's the same. Some sort of noise. Are you referring to my teaching? Some sort of noise? I hope not. Okay. Mild beep sound. There is some fan which is running over here to cool the system. Okay, is it a major disturbance? You let me know that. Is it okay? Can you adjust to that and continue with the class? The person who's on the video is rotating her head in all direction, which confused me, but then finally she gave a thumbs up. Not you, Sri Lakshmi. Yeah, thumbs up. Thank you. Now it's clear. Earlier you were like rotating your head in all direction. I didn't understand what it meant. Okay, fine. It's okay. So I'll proceed. Okay, so anyway, savings deposit, I told you before I proceed to the next one. In savings deposit, there are some specialized type of savings deposits. For example, salary account. If you're working somewhere and the organization is giving you a salary account, there the bank knows for sure that every month there is going to be some deposit and some withdrawal that is going to happen. So there is assured banking activity. Bank says no need to maintain minimum balance. So zero balance account. So no need to maintain minimum balance. Similarly, the government says a person is already poor. Okay, we are trying to create the bank account for them, and we want them to use it. So if you are going to go and tell them that you have to maintain 500 rupees or 1000 rupees without using, people may not open a bank account in the first place. So when we have accounts like Jan Dhan accounts, you would have heard of Jan Dhan account. Okay, Jan Dhan account, those are specialized type of savings account, which again does not have any minimum balance, zero balance account, for the sake of convenience of the people. Okay, those are exceptions to the rule. The rule is minimum balance has to be there, but salary account or Jan Dhan account are exceptions to the rule. They are also types of savings account. Salary account is a type of savings account. Jan Dhan account is a type of savings account. Okay, that's about savings account. This I'm keeping aside for business. So moving on, number 2. Now, can the bank use money from a savings account for multiplication? There is one aspect which the bank needs to know for sure before they can lend out money. What do the bank needs a guarantee of? What is the guarantee that the banks require before they give the money out as loan? Correct. That no, Rahul, you're talking about when you're trying to borrow money is what you're talking about collateral. Okay, I'm saying before a bank has the confidence to give out the money to someone, the bank needs some sort of an assurance from the depositor. Yeah, correct. So Sri Lakshmi has answered, Archana has also answered. Sri Lakshmi's answer is that there won't be any immediate withdrawal, and Archana's answer is that deposits are there to be there for a definite period of time. So the bank requires an assurance that the money that is deposited will not be demanded immediately. So can bank use the money in demand deposits, in savings deposit? Can bank use that money for giving out loans? They can use this part. The time liability part they may be able to use, but they cannot use the demand deposit, because by law itself or by the nature of the account itself, it can be demanded at any time. I may go and demand it today, I may go and demand it tomorrow. I am not giving any assurance to the bank that I will not demand it anytime in the near future. So the bank does not have an assurance. The bank cannot use this money for giving out loans. It is almost like idle money with the banking system. But why is bank still doing this? Why is the bank still doing this? This acts as an incentive for people to think of depositing for a longer period of time. So what could be an incentive for the people? The bank may say, in a savings account, I'm only giving you 3%. If you keep the money for an assured period of 6 months, I'll give you an interest of, let's say, 4% or 5%. If you keep it for 1 year, I'll give you 6% interest on it. So we will get very motivated by that. We'll get incentivized. We think of that as a very good thing, and we'll say, okay, I don't need the money now. You keep it for 1 year. For 1 year, you keep paying me interest. After 1 year, I'll come and take the money. I will not come in between and ask for the money. Now the bank has an assurance that, okay, this money is going to remain with me for 1 year. So for any duration less than 1 year, I can give it out as loan. The bank has that assurance. So those types of accounts are called as fixed deposit account. But don't get confused by the term fixed here. The term fixed here does not refer to the duration. The duration may be 3 months, the duration may be 6 months, the duration may be 1 year, 2 years, 5 years. That is also fixed. But look at it. It says fixed deposit. So deposit amount is fixed. In this type of account, if you deposit 1 lakh rupees, then you cannot increase the deposit later. You deposit 1 lakh rupees for 1 year, you cannot go after 2 months and say, I'll deposit even more money into that account. It is not allowed. So the deposit amount is fixed in nature. Of course, the duration is also fixed. You will get into a prior agreement for that. So fixed deposits are a fixed amount of money which is deposited into your account for predetermined duration, which could be 3 months, 6 months, 1 year, 2 year, whatever be the duration. There are different durations which banks offer. So because it is for a predetermined duration, these are not demand deposits. These are what we call as term deposits. or term liability. This is from depositor's perspective. This is from bank's perspective. Okay. Now I told you earlier that the moment the money cannot be withdrawn on demand, you call that money as a time liability or a time deposit, because there is a time factor which comes in. When we know what the time is, we'll call it as term deposit or term liability, because we know the term for which the money is going to be there. But in the case of minimum balance, we don't know the term. I may close my account tomorrow, then the bank will have to give that money. I may close that money bank account 1 year later. At that point, the bank may have to give the money. The bank doesn't have any assurance as to how long the account is going to be there. But as long as the account is there, the money will be there. So we simply call it as time deposit, because we don't know how long it is going to be there, but it is going to be there for as long as the account is there. With term deposit, the bank has a clear idea. The money is going to be here for 3 months. So remember, term deposit is a type of time deposit. Time deposit can be divided into two, where time is known, where time is not known. Where time is known, it is also called as term deposit. Where time is not known, you simply call it by the term time deposit itself. Time deposit classified into term, no term. No term is called by this name itself, but term deposit, time deposit with a known time is called as term deposits. Known duration, unknown duration. That's a classification that is there. Okay. Now you need to understand why I am focusing on these parts of the account, because what is the major heading that we are learning? We are learning about money multiplication. That is why we are learning this topic. For money to multiply, money has to come into the banking system, but coming alone is not enough. It has to remain in the banking system for a period of time, so that the bank has the opportunity to give it out as loan and the multiplication to take place. So this is the reason why even when we are learning about these accounts, it is with the purpose of learning about money multiplication. So we are classifying it as money which is demandable, money which is not demandable for a period of time. That is how we are classifying it at, in the first place. Okay, that is the reason why we are learning these points about these accounts. And remember, we are not learning about banking to learn about banking. We are learning about banking to learn the concept of money multiplication. Otherwise, you would be learning this under a chapter called as banking. We are learning it under a chapter called as money. Okay. So that is fixed deposit. But there is another deposit where people may feel, I don't have a lump sum of 1 lakh or 2 lakh rupees to come and deposit. I only have small amounts of money. I'm a regular salary earner. Every month I can come and deposit 10,000 rupees in your account. Out of my salary, I can save that money and I can come and deposit. But I don't have that amount in one go. Do I have an option? The bank says, if you can provide me an assurance that you will not come and ask this money for 1 year, I'll allow you to regularly deposit 10,000 rupees. Every month you deposit 10,000 rupees into your account, and we will accumulate the interest on top of that. This is called as a recurring deposit account. Recurring is nothing but reoccurring deposit. It happens in a predetermined duration. In intervals, it happens. So recurring deposit account. This is what we call as FD. This is what we call as RD. It is also a type of term deposit or a time liability. Okay. Clear? That is all from the perspective of household. That is all that we have from the perspective of household. Now coming to business accounts. So business accounts. Number one, see, businesses always require money. Businesses are always in need of money. There will not be a case where a business will say, let me deposit money in a bank. Businesses are always in search of money. They don't have enough money. So they go to banks and say, please give me a loan. That is the nature of business itself. Normally, businesses would not have money to deposit. But there might be a case where businesses, even if they don't have money to deposit, they might require an account with the bank. Why? Because it is very difficult to transact always in physical cash. So you may say, all my money, let it be in your account, but I am not even giving the guarantee that I'll use it tomorrow. In savings account, what you're saying, I don't need the money today, I may use it tomorrow or day after tomorrow. So you call it a savings for the future. A business is saying, I will use the money today itself, but I still want to keep it in an account because carrying physical cash is difficult for me. So you have something called as current account. For saving, you are saving the money for future, savings account. Here you require the money for immediate requirements. Current requirements, you need it. Okay, for current requirements you need it, but still you deposit the money for ease of transactions, in order to not carry the money physically from place to place. For safety, for security, for ease of transaction, you create an account. Current account. Is it a demand deposit or a term deposit? Correct. Okay, it is a demand deposit. It will be demanded at any given point of time. In fact, because businesses are always using their account, there is no question of the account remaining idle. So in general, current account does not even ask for a minimum balance, because there is always business activity that is taking place. Okay, so current account does not actually ask for any sort of minimum balance. So which means that in current account, time deposit or time liability portion is not going to be there. Only demand deposits will be there. Again, this is not something which is going to help in money multiplication. But there are some rare occasions where even businesses, they don't have immediate need of money, especially seasonal businesses. Businesses which boom during a particular season and which don't have a lot of scope in another season, they may have money for short durations of time, for 10 days, for 15 days. They don't have anything to do with the money. They'll think, why keep the money with ourselves? If we put it in a bank, we can earn some level of interest out of it. If they don't have any other scope of investment, so they deposit the money, for which the bank will lay a condition. If you're depositing money, you'll have to deposit in multiples of lakhs. There is no concept of 1,000 there. You're depositing money for a short duration, like 10 days or 15 days, I'll allow you to deposit. I'll also give out loans. I'll give out 7-day loan and 10-day loan, and all those. Banks do that. They give out 10-day loans and 7-day loans. So, but if you're depositing money, you have to deposit in multiples of lakhs, for which the bank will issue a certificate for you. This is called as certificate of deposit. So this is a term deposit of very short duration. Invariably, it tends to be less than 3 months. You'll very rarely find a certificate of deposit which is greater than 3 months. There's no rule which says so. It could be for longer period. In general, it is for lesser than 3 months. It could be as short as 7 days. 7-day term of deposit is also, certificate of deposit is also there. You deposit for 7 days, after that you take the money. In the meanwhile, the business will give out a 6-day loan. You deposit for 7 days, the business will give a 6-day loan to someone. That person will use the money for 6 days, whatever their immediate requirement. Suddenly I'm out of cash. I borrow for 6 days. 7th day, I'll give it back to the bank. My requirements are over. I was supposed to get the money from somewhere else. I got it. I'll give it back. Okay. These sort of loan systems work a lot in the banking system. So this is an example of a term deposit, but for a very short duration. Okay. This will contribute to money multiplication, but to a very small extent. Not a great extent. To a very small extent, it will contribute. Okay. So these are the accounts in a business perspective. Now, this is all that is enough for us to understand the concept of money multiplication. But because we are learning the topic of deposits, I'll also tell you about 3 more types of deposits. Deposits of non-resident Indians, NRI. First question, are NRIs Indians or are they people of Indian origin who are not Indian citizens? That's the first question. Okay, a few questions that have come up. Sarah, yes, I can repeat RD, but when we take a small break, I'll repeat RD for you. Any other question that comes up, I'll answer during a break, during a pause that I take. Anu says they are Indians, Karan says they are Indians, Archana says they are Indians, Kishore says they are Indians, Sri Lakshmi says they are Indians. Are you all sure about this? Are you sure they are not people of Indian origin living outside? Okay, Tanuja is also very confident they are Indians. You are a very informed class. You are correct. They are all Indians because in the name itself it says non-resident Indians, right? So there is a different classification called persons of Indian origin, PIO. They are not Indians. They have taken the citizenship of some other country, but they have an Indian heritage. Once upon a time, they were Indians, or their parents were Indians, or their grandparents were Indians. They have Indian heritage. Those are persons of Indian origin. PIO, that's a separate classification. NRIs are very much Indians. They are Indian citizens. The moment a person ceases to be an Indian citizen, the person will not be an NRI anymore. You cannot call that person an Indian anymore. The person was an Indian, so we call that person a person of Indian origin. Okay, so that is the concept, correct? So they are Indians who are residing out of India. For a person to get a classification of non-resident Indian, the person has to be ordinarily resident outside India for a period of more than 6 months. So I think the correct number is 182. More than 182 days, 365, right? So 182 and a half. So if you have been residing outside India for a continuous period of more than 182 days, you will be classified as a non-resident Indian. Okay. So you will think if I go on a, let's say, US trip, I go on a US trip, I live there for, let's say, 7 months, will I become an NRI? No, you will not get such classifications easily because they will not give you a visa to live outside India for more than 6 months. Tourist visa, the duration itself will be for 6 months when at one stretch, right? So they'll ensure that you don't become an NRI just because you went on a fun trip. That will not happen. Don't worry. Okay. So NRIs, the moment they become an Indian, becomes an NRI, all the accounts that they are already holding inside India, or if they are trying to create a new account in India, those accounts get converted to non-resident ordinary account, NRO account, NRO account, non-resident ordinary account. It could be in the form of savings deposit, it could be in the form of FD, RD, it could be in any form. It could be a current account deposit, it could be a certificate of deposit. But the moment you are classified as an NRI, your account turns into an NRO account. Okay. That is what is a non-resident ordinary account. If you don't have any account in India, you are living abroad, you want to open an account in India, that will also be an NRO account. Okay. However, there is an issue with NRO account. You cannot take money from NRO account into the foreign country, or you cannot deposit money from foreign country into your own account. You cannot do that, right? So repatriation, which means withdrawing, using a complex term there, it means withdrawing or depositing from abroad or into abroad is not allowed. Not allowed. If you want to deposit money from abroad into your own account, foreign currency into your own account, or you want to withdraw money from India into a foreign country, you need to create a special classification of account for that. Your normal account itself, your savings account or your FD or all those, it will get reclassified into non-resident external account. But I have left a gap over here. Why? Because we are going to call it as a rupee account. Non-resident external within bracket rupee account. You can deposit money from abroad into this account. You can withdraw money from this account into your whichever foreign country you are living in. Okay. Non-resident external rupee account. Why the word rupee over here? It is called as NRE account, non-resident external account. But why do we call it as rupee account? Because if you deposit $10 into this account, you deposit $10 into this account, how much will be reflected in the account? Not $10. What will be reflected is the Indian equivalent of this. Let's say 75 rupees to the dollar, 750 rupees will be reflected in this account. So this account is denominated in Indian rupees, not in the currency that you deposit. Whatever currency, not dollar, euro, or whatever currency. The currency you deposit doesn't matter. It will be denominated in Indian rupee. Okay. Remember, in order to receive money from a foreign country, you don't need to have an NRE account. You may have a relative living abroad, they may send money into your account. You don't need an NRE or an NRO account or any of those. I am not saying to receive money from abroad, you need this money, or to send money. Let's say you have a child or a sibling who's studying abroad, you need to send them money for their education. You don't need any of this account. Your normal Indian account, you can transfer money. We are saying if you are depositing money in your own account in India, you are an NRI who's depositing money into your own account, then you need this account. Now, what is the difference? Okay, understand this. When you are depositing money into someone else's account from abroad, it is called as remittance. Your parent lives abroad, your parent sends money into your account, it is called as remittance. Why? Because the money comes into India, the money cannot be withdrawn by the person who sends the money. You may choose to send the money, but they cannot automatically withdraw this money because they don't own this account. So that is a remittance. That doesn't require any of these. Okay, because the money is going to stay in India. But if someone abroad, let's say your father lives abroad and they're sending money, depositing money into his own account, living there, situated there, he can withdraw that money at any given point of time. Correct? Because that person owns the account. It is so that is not considered as remittance. Depositing money into your own account in India from abroad is not remittance. That is just deposit. That can be withdrawn at any time. It is not India's money to hold. So that requires NRE account. I hope this distinction is clear. Okay. If you are if an NRI is depositing money into their own account, NRE account is required. Only into that deposit can be done. But if an NRI is depositing money into some other relative's account, that account need not be an NRI account because that account is not owned by the NRI. It is owned by some Indian who's living in India. I hope this distinction is clear. Okay. Now, there is a problem with NRE account. If you are living in a country with a stronger currency than India, if you are living in a country with a stronger currency than India, let's say dollar, you deposit $10 today, you have 750 rupees in your account. Okay. You withdraw the $10 1 year later. By the time of 1 year, maybe here $1 is equal to 75 rupees. Here $1 is equal to, let's say, 80 rupees. Okay. Let's say this 750 rupees has grown to 770 rupees based on interest, the interest earning. Even then, when you withdraw 770 rupees, you will not get $10. You will get probably $9 or $8 or something like that, 80 rupees, 720, maybe a little more than $9.5 or whatever. That is all that you will get. Why? Because the money is denominated in India and the money is growing also in Indian currency. There is this factor of exchange rate which comes into the picture. Exchange rate, because the money is being deposited from a stronger country and that currency is appreciating, Indian currency is depreciating, You will learn about appreciation, depreciation in external sector. Don't worry, I'm just using the term in general sense. If that foreign currency's value is increasing, then you may stand to lose. But you will gain if you are depositing money from a weaker country, a country which has a currency which is weaker than India's. Then you tend to gain. But most of the deposits come from countries which are stronger. So what you have is, for their sake, the banks have created another type of account called as foreign currency non-resident account, FCNR. FCNR account. Okay. FCNR account, foreign currency non-resident account. When you come across this term FCNR account, sometimes you may also come across this term B in bracket. FCNR in bracket, you will find the letter B. What does the B there indicate? B refers to bank. B refers to the word bank. FCNR, bank account. Now, what is the significance? This account is going to lead to a loss for the banking system. This account will lead to a loss for the banking system. Why do I say so? $10 is deposited into the account. Okay. So rupees 750 is there. $10 plus interest. $10 plus interest. Let's say $11 is withdrawn from this account after 1 year. Okay. The denomination happens in dollar, not in rupees. So it is not going to be interest calculated on this and 770 rupees being given or anything like that. They compulsorily have to give $11. If it is 80 rupees per dollar, they'll have to give 880 rupees in order to give $11. So it is a potential loss for the bank. Okay. Prior to 1991, when the economy was not liberalized, the RBI was controlling these activities. So the RBI took up this particular loss due to the rate of exchange, loss due to depreciation of Indian currency was taken up by the RBI in the old FCNR account. But after liberalization, RBI said, we have liberalized everything. We have given you the freedom to accept deposits and do whatever you want, charge whatever rate that you want. So you take up the burden of exchange rate difference also. So who pays that? The bank pays that. To differentiate from the old account, old FCNR account, the current, for the last 20-30 years, it has been FCNR. Bank has been paying that FCNR account. But there is the name B because there was a time when there was an FCNR account where the bank was not paying the exchange rate difference. The RBI used to pay that. That is all. Okay. These are 3 types of accounts that are there. One key point is this account is purely a term deposit account with a minimum duration of 1 year and a maximum duration of 5 years. Why minimum duration of 1 year? Because see, in spite of a loss happening here, why would bank agree to take this deposit in the first place? That is a question that should come to your mind. We are saying there is a high potential for loss. Why is bank agreeing to create such a deposit? Because the bank will have more and more of foreign exchange in its hand, which means that it can attract a lot of trading customers, exporters and importers, especially importers. It can attract a lot of importers to come and exchange the foreign currency from them, which means that the bank can charge a commission on that and make earnings out of it. So in order to increase the foreign exchange available in the bank, they'll accept these deposits. But to be sure of the money that is there, they need the money for a predetermined period of time. So they'll say minimum for 1 year, you have to deposit the money if you are depositing from abroad. So FCNR account can be created only as a fixed deposit with a minimum duration of 1 year. And there is also a maximum duration of 5 years because more than 5 years could lead to a lot of loss for the bank. The bank may not be able to bear that loss. So they say maximum period of 5 years, minimum period of 1 year. That is a feature of FCNR account. Now with this, we are done with learning all different types of bank accounts. We are going to go back to our major topic of money multiplication. In order to learn that, I am going to introduce a term called as monetary aggregates. Monetary aggregates. We are going to learn about money aggregating. And where is money aggregating? Money is aggregating in the banking system. In what way is the money aggregating in the banking system? Whatever we have learned so far, we are going to put it all together in the form of a formula, in the form of an equation. Okay, very simple. I'll teach you a very simple method of remembering this. Do not try to memorize it, just understand the concept. That should be enough. Okay, so what is our objective? Our objective is to find how much is the money multiplying. For that, first we need to know what is the base that we are talking about. What is the base? You remember in the earlier example, 100 rupees multiplied to 400 rupees. Okay, so what is the base on which the multiplication is starting? So first we have something called as base money, or it is also called as reserve money, because this is the actual amount of physical currency that is there. This is the actual amount of physical currency that is there. This is the reserve amount of money that is there. Only physical currency that is there. And also because it is the base on which everything is built, it is also called as base money. It is called as base money or reserve money, or it is also called as high powered money. Why is it called as high powered money? Take the example that I gave you. 100 rupees is the reserve money, right, or the base money. 100 rupees has the ability to play the role of 400 rupees. Yes, through money multiplication, 100 rupees has a power much higher than what the number indicates. So it is also called as high powered money. Money which has a higher power than what the number indicates. This is referred to as M0. This is referred to as M0, monetary aggregate 0. Okay, it is referred to as monetary aggregate 0. All right, what is inside it? The total money that has been printed. The total money that has been printed in the economy. Now, we ask a question, who are the various entities that are there with respect to money in the economy? There is Reserve Bank of India, which prints the money. So Reserve Bank of India has an idea how much money it has. It knows how much money it printed, but it also needs to know a split of where is the money going. RBI interacts with banks. So some amount of money is in the banking system. Banks interact with public. So when I say public here, you remember, probably I didn't tell you because I didn't start with public finance for you. The word public has different meanings in different contexts in India. In public finance, the word public meant the government. The word public meant government, public sector enterprise, government owned enterprise. Okay. Here public means anyone in the country other than RBI and bank will be public. Households are public, businesses are public, government is public, everything is public. Everything other than RBI and banking system is public according to this classification. So some money is in the hands of the banks, some money is in the hands of the public. So RBI says the money that is there in the public plus the money that is there in the banks, plus if there is some money that is there in the hands of the RBI itself, for some reason if the RBI has that money, then that is the total amount of money that is there in the economy, physical money. So to understand this, please note this down, this particular picture. I'm going to erase it. So RBI says if there has to be a formula for how much money is there in the economy, they are going to say M0 is equal to currency in circulation in the economy. Okay, currency in circulation in the economy plus bankers deposits with RBI for some reason. Okay, you remember in money multiplication I told you 100 rupees comes into the bank, 10 rupees is kept as reserve, 90 rupees is given. So that reserve is kept, right? some part of that reserve is kept by the bank with the RBI itself. There is a compulsion according to the RBI Act. Some part of the money has to be kept as a reserve with the RBI. Later in class in inflation, we learn it as cash reserve ratio, CRR. We will learn about it later. So that is what I'm referring to here. Bankers deposits with RBI plus other deposits with RBI. What are the other deposits with RBI? Very simple example. Staff of RBI have an account with RBI itself. Their salary and everything is credited into an account within RBI. Because you cannot be an RBI staff and have an account in SBI, because you might make rules which are favorable to SBI. To maintain neutrality, RBI provides an account to its own employees. Okay, all their PF account and salary account and all those. Similarly, the President of India, their account is with the RBI. The government's finances itself is with the RBI. Government's money. We said government's banker is RBI, functions of RBI, right? In addition to all these, India is a member of various international organizations, okay, like International Monetary Fund and World Bank and all those things. To become a member of those, we have to give a membership fees to them. We have to give a membership fee to them. Imagine you want to be a part of Rotary Club or Gymkhana Club and all those. They provide you a lot of facilities, right? You can conduct marriages in your family there. You have fun time there. You can go with your family. There is playing avenue and all those that is there. Various clubs that are there in the cities, okay, or even in rural areas. But to avail those facilities, to become a member of that club, you need to make a membership fee. So similar to that, to become a member of IMF and all those, you need to pay a membership fee. The membership fee is normally paid in foreign currency, because why would IMF accept Indian rupee? But if they ask for the entire money in foreign currency, India may not have enough money to pay for that. Not just India, all the countries in the world, they may not have as much money, as much of foreign currency to pay. So those organizations will say a small portion of it you pay in foreign currency, the remaining portion you pay in Indian currency. So India RBI will make that payment on behalf of the government in Indian currency. Now you think, what is RBI going to do with Indian rupee? What is IMF going to do with Indian rupee? Or what is World Bank going to do with Indian rupee? They are not going to be able to use it anywhere else outside. So what they'll do, whatever Indian rupee that they have, they will deposit it back with RBI and say, I will come and ask this money whenever I want. Till then, you give me interest. Okay. Similarly, when RBI has a lot of foreign currency, we talk about forex reserves and all those. RBI has a lot of foreign currency. What will RBI do with foreign currency? They have currency, they'll give it to. RBI has dollars. RBI uses that dollar to give a loan to America. Indian RBI gives a loan to America and says, give me a security for that. Because no country can use that foreign currency for any purposes. It will remain stagnant. Whereas if that money is given to USA, USA can use it for their needs. If IMF gives that money to RBI, RBI can use it for our needs, the local needs over here. But whatever amount is there, the ownership is with IMF in that case, and they'll charge an interest on that. So those also will come under other deposits with RBI. These are examples of money that is there as deposits with RBI. This is also money that can come into circulation. At this given point of time, it is with RBI, so it is not circulating, but the RBI may use it for circulating. This is what we call as base money or reserve money or high powered money. Okay. So what is currency in circulation? Currency with public plus currency with banks. So I told you money is there in three places. Money could be with RBI. Money could be with RBI, two different types, and money could be with the public or the banks. You remember the triangle sort of thing that I do? RBI, banks, public. So RBI, banks, public. Now, why do we split RBI into two? Simple reason, this money can come into the economy for circulation. This money will not come into the economy for circulation. Why not? Because it's reserve money. It is in order to protect the deposits that the bank is keeping a reserve with RBI. If the RBI uses it into the economy again, there is no protection of that money. So this is money which will remain idle even with RBI. It will remain idle with RBI. RBI wants to take that money out of circulation. That is why RBI wants to keep that as keep the money with themselves. So which is why even among the money with RBI, we are classifying money with the RBI which will eventually come for circulation and money with RBI which will not come for circulation. Bankers' deposit with RBI is money that will not come for circulation. Okay. All right. So now this is M0. Now we are actually getting into the small level of multiplication that is going to happen. We'll start with a very, very small level. We'll call it as narrow money. See, it is called as narrow money because the availability of this money for a bank for the purpose of multiplication, for the purpose of giving out loans is very, very limited. The banks cannot really use this money for giving out loans. They may be, but for a very short duration. Narrow money or M1 is equal to currency with public. In the name itself, we have said it's currency with the public. So does the bank have any access to this? No, they don't have any access to this. Will it contribute to multiplication? No, it will not contribute to multiplication because the money is in the hands of the people, right? Currency with the public plus what else does not contribute to multiplication? Demand deposits with the banking system. You understand what is meant by demand deposits with the banking system? This demand deposits consists of two things. One, current account deposits. Second, demand liability portion of savings deposit. Do you understand what I'm talking about? When I say demand deposits in the banking system, there are two things. Current account deposits. Because I told you the entire current account is demandable. And I told you savings account is also demand deposit, but not the entire savings account. The demand liability portion of savings deposits. Savings deposit is divided into demand liability and time liability portion. The demand liability portion can be demanded at any time. So that is also not quite available for multiplication. Plus other deposits with RBI. Why do we add this? Because the RBI does not give out loans with that money. RBI is not a bank per se for the people of the country. If there is money there, it is there. Other people may have ownership over it. The RBI may bring into circulation, but RBI does not give it out as loan. So these are classifications called as narrow money. Narrow because the scope for money multiplication is very limited. The scope for the banks to use this money is very limited. As long as the money is in the hands of the people, the bank cannot use it. Demand deposit is almost equal to money in the hands of the people. So that is also not contributing much. Other deposits with RBI is not even with the banking system. So it is also not contributing much to money multiplication. I'm erasing this part for space. So this is M1. Now, next is ultimately we'll reach broad money. Narrow, broad. Broad is the highest liquidity that is there. But we are talking about gradual progression. So after narrow, we have something called as intermediate money. M2. Okay, before I mention the first term, let me ask you a question. What is the broad heading that we are learning? Think about it. What is the broad heading that we are learning? Monetary aggregates. Also remember, when I say money multiplication, When I say money multiplication, the initial 100 rupees is added, the final 60 rupees is also added. When the entire money multiplication happens, all the money is added. Okay. Now we are trying to aggregate the money money that is there in the economy. So we are going to say intermediate money will start with M1 plus, because we are learning aggregation. In addition to this, what more money is there? That is intermediate money. Okay. In addition to this, what more money is there? That is aggregation. All right. So we'll talk about M1 plus. First thing, what is slightly more liquid? So do you understand the term of liquidity? Do you know what is meant by liquidity? Liquid money is something, or liquidity is something that flows easily, that is used for transactions very easily. Okay. Money which is available for easy use. Just take an example, just a small pause. Take an example. We have three things. Let's say land, gold, cash. One more. Okay. FD and cash. FD is fixed deposit. Okay. Now arrange it in the decreasing order of liquidity. You will say land is the least liquid, because you own land, you cannot immediately convert it to money. You need to go find a buyer, convince them of the price, and interaction has to take place. Then the conversion has to happen. You have to go to the government, register it, all those. Converting this land into money is going to be a little difficult. This is least liquid of the four. It is an asset, but it is the least liquid asset. Second, gold. It is also not very liquid, but you can go to any gold shop and you can get the money. You can go to any pawn broker and get the money. Okay, gold. Then after that, you have FD. Now depends. Sometimes gold is more liquid than FD. Why? Because if you have deposited FD for 1 year, you cannot access that money. But gold, you may be able to find a buyer immediately. So then what will happen? FD will come here and gold will go over there. So it depends. So that is FD. And finally, cash. You have immediate money, you can spend it. Okay. So what does the term liquidity mean? Ease of access to money for transaction. That is what is liquidity. So land is least liquid, cash is most liquid. Land is least liquid, cash is most liquid. Now why am I telling you about this? Because we are classifying accounts here based on the liquidity of that money from a bank's perspective. From people's perspective, what is most liquid? Cash in hand is most liquid. But from bank's perspective, what is least liquid? Cash in people's hand is least liquid. Or demand deposits are least liquid because the bank cannot use it. What is most liquid for a bank? FD for a long period of time. FD for 5 years is liquid for that period of 5 years from a bank's perspective. FD for 4 years, less liquid. FD for 3 years, less liquid. FD for 1 year, less liquid. FD for 6 months, less liquid. Demand deposit, not liquid at all. So it is based on liquidity that we arrange. Narrow money means narrow liquidity. Intermediate money means intermediate level of liquidity. But we are learning aggregates. So we'll say M1 plus money which is available for slightly longer duration than M1. Time liability portion of savings deposits. What is this? I told you in demand deposits, there is demand liability portion of savings deposits. This is the minimum balance portion. Time liability portion of savings deposits plus certificate of deposits. I told you generally certificate of deposits are lesser than 3 months. It could be 7 days, it could be 2 weeks, it could be 1 month, it could go up to 3 years. Okay, and finally we'll add one more term over here, fixed deposits or term. I'll not use the word fixed deposit because RD is also there. So term deposits of households, but not all term deposits, households with a maturity of 1 year. With a maturity of 1 year. Okay. Now, a few reasons. Term deposit, you know what it is. I've already told you. Of households. Why? Because certificate of deposit is also a term deposit, but of business. So we are clearly classifying term deposits of business separately and term deposits of household separately. This includes FD and RD. Okay, this includes FD and RD, but with a maturity of 1 year. Now you have to understand that in general in economics, 1 year or lesser is considered as short term, more than 1 year is considered as long term in general. Okay, that is how, especially when it comes to money, the matters of money, when it comes to the share market and all those, everywhere money matters, there is a clear classification of 1 year or lesser and more than 1 year. That is a clear classification with respect to liquidity. Okay, one is considered as short term, 1 year or lesser is considered as short term, greater than 1 year is considered as long term. That is how it is done. So that is the reason why you have a classification of maturity of 1 year. Okay, normally money which is borrowed for less than 1 year is considered to be used for day-to-day requirements of the company. We call it as working capital. Companies borrow money for short durations for their day-to-day requirements. But when the borrowing is for greater than 1 year, they use it, generally they use it for investment purposes, for expanding their business and all those. So it is to bring in that classification that we have this cutoff of 1 year. That is the logic behind it. Okay, so that is what is called as intermediate money. And the third type that we have, okay, third type that we have, M3, or I'll write the name and then use the wording. We call it as broad money. M3. Okay, broad money M3 is equal to, what will be the first term? Can someone type in and send? Is it M2? Is it not M1 plus M2? Okay, so you guys are very difficult to trick. NRI also you didn't get tricked. Now also you didn't get tricked. Okay, last class I think there were some people, one of whom is on the video, who got tricked into answering some wrong answers a few times. Yeah, but anyway, your logic is correct. Archana's logic is correct. So M2 itself already includes M1. So there is no need to write M1 separately. So M2 plus what is left over? Term deposits of residents with maturity, or residents or households. I use the term households in the last one. So households with maturity more than 1 year. This is what I have taught you so far. These are the types of accounts that I've taught you so far. But in addition to this, banks also get money from one more place. Banks get money from, okay, actually two more places. Banks get money from other banks. If a bank is falling short of money, they may borrow money from another bank. But if that happens, then the money borrowing is happening within the banking system. We already classified money as money with the RBI, money with the banks, money with the people. Okay, so if bank is borrowing among themselves, that is money within the banking system. It is not going to affect this aggregation. Now, bank, in addition to getting all these deposits from the common household and businesses, bank may sometimes borrow money from other businesses which are similar to banks, not as deposit, as a loan from them. Okay, so when bank accepts money from us, they don't call it as loan, they call it as deposits into the banking system. Bank is borrowing money from us, but they don't classify it as loan, they classify it as deposits into the banking system. Be it a household or a business, whoever it is, when they deposit, it is considered as deposits. But sometimes bank, when they borrow from organizations whose primary role is to lend money, non-banking financial institutions, when banks borrow from non-banking financial institutions, that is considered as borrowing itself, not as deposit. Sometimes banks borrow from these non-banking financial institutions, which is to say, SBI may go to Sundaram Finance and say, can you lend me some money because I'm falling short of money? Not just Sundaram Finance, SBI may go to LIC and say, you are not a bank, but you have a lot of money, you do lending activities, can you lend some money to me? LIC is a non-banking financial institution. Okay, in our classification of three, RBI, bank, public, where does LIC come in? LIC comes under the heading of public, because they are not part of either bank or RBI. So here money is shifting from the hands of public into the hands of banks. So we'll say call or term borrowings of banks. Borrowings are done by banks from non-depository financial institutions. Here I am specifically using the word non-depository financial institutions because that is the word RBI uses. But the idea is non-banking financial institution. Why the word non-depository? Because these organizations cannot accept demand deposits. You remember I told you payment services is offered only by banks. What is payment services? Payment on demand. So they don't accept demand deposits. These LIC, you pay your premium, but you cannot go and withdraw money from there. Okay, that is the idea behind it. Non-depository financial institution means an NBFC. Bank borrowing money from them, that is also available in the banking system. Okay, that is part of broad money. Right, now two more terms to explain. What is call and what is term over here? Call is borrowing which is done for one day actually, overnight borrowing. You borrow in the evening, you give it back next morning. You might wonder, why would anyone borrow? See, normally we require money for our day-to-day activities, right? So why would anyone borrow in the evening and give it back in the morning? Because banks have a condition, have a criteria that at the end of every day, they have to maintain a balance sheet. They have to show a balance in their account. It is a necessity for every bank. You would have seen this probably. You go to a bank, 2 o'clock, they'll shut down. And then after that, they are doing something secretly inside after 2 o'clock. You would have wondered what they are up to, all this banking staff and all those. What they are doing essentially is they are looking at all the account books and they are saying, is there a mismatch? If there is a mismatch, they'll call up other banks. Can you lend some money? Interbank lending. We don't care about it because it is within bank. We don't care about it. It happens. But sometimes when it is not available from the banking system itself, they'll go to non-banking entities, non-depository financial institutions and say, can you lend me some money till tomorrow morning? Okay, and they'll get the money. That is what is called borrowing. Term borrowing is when they borrow for a longer period. Anything more than this is term borrowing, 7-day borrowing, 14-day borrowing, all those. That is one part answered. Now comes the second question. If it is for overnight or 7 or 10 days, why are we putting it under M3 and why not under M2 or M1? Because that is what we have been doing so far, right? On liquidity. Now the answer to that is, see, everywhere else we have been learning about money which comes into the bank from normal people, okay, who are just depositing money because they don't have anything else to do with the money. But these are money that is taken from organizations whose primary role is to lend money. The more they lend the money, the more profit that they get, which means that this is money which is easily accessible for the banking system. whenever they want money, they can go and get it from the non-depository financial institution. Although we call it as call money and the duration is overnight, what essentially it means is the interest rate is charged overnight, but the money can be retained for as long as the bank wants, because the longer the bank retains the money, the better it is for the institution which lend them the money. Which means from a bank's perspective, this is even if the interest rate is calculated on a daily basis, it is money which is liquid. What is liquidity? Easy availability of money. Although this loan is considered as overnight, it is only the interest rate which is calculated overnight. For every day, they will have to pay an interest. Normally, we talk about interest per annum, right? This is per day interest. Although it is per day interest, the money is easily available for the bank, because whenever the bank wants, they can get this money. Whenever the bank wants, can they come to our household and say, give me some money? The bank cannot say that. To normal people, they cannot say that. So that is not liquid money for them. But this money, be it call, be it term borrowing, both the cases, the money is easily available for them. That is why we put this under M3 and not under M2 or M1. Okay. So this is the concept of M3. Now, if you look at it, okay, just imagine you as a resident has put in some money over here for a 3-year deposit, 3-year FD, term deposits of household with a maturity more than 1 year. You put it under this account. Okay, that will be classified into this account. You put 1 lakh rupees, let's say, for 3 years. That money is lent by a bank to someone who uses it for business and gives it as a salary to someone. That 1 lakh rupees may come back into the account as term deposit of household with a maturity of 1 year. It is possible. That same 1 lakh rupees will be given as a loan to someone else. It may go and it become currency with the public. So there is M1, there is M2 which is inclusive of M1, and then there is M3 which is inclusive of M1 and the other aspects of M2 as well. Okay, which means what? The 1 lakh rupees that you deposited here plus all the other role that that money is going to play. The 1 lakh rupees plus the next lending plus the next lending, all that comes into the banking system is represented in this M3. How many ever times in the going by the old example, the 100 rupees is here. When it becomes 90 rupees, that is also here. When it becomes 80, that is also here. When it becomes 70, that is also here. When it becomes 60, that is also here. When people retain it as cash, that is also here. Why? Money retained as cash is part of M1. Look at the first term in M1, currency with the public. That M1 is also part of M2. That M2 is also part of M3. So M3 gives us an idea, is an aggregation of total money that people in the economy believe they own. You ask everyone how much is there in the bank account, people will not reveal, but the bank will reveal. So everyone believes this much amount of money is there. M3 is indicative of the total money that people believe that is there in the economy. In other words, M3 is equivalent to the GDP of the country. Because what is GDP of the country? The total value of all final goods and services. How much money should be there in the economy? Whatever is the total value of goods and services in the economy. Final goods and services. So whatever is the GDP, that much amount of M3 would be there. Okay. So this is the total money that is circulating in the economy, that people believe is circulating in the economy. This is what we call as money supply in the economy. So now if we say M3, in our old example, M3 was 400. Okay. In our old example, M0 was 100. What is the value of money multiplier? What is meant by money multiplier? By how much value is the money multiplying? M3 divided by M0 will give us the value of money multiplier. Okay. Now look at this. For the first year, when the RBI has no idea how the economy is performing, imagine a fresh economy where RBI has no idea how the economy is performing. First year, they'll print some money. They'll see what people are doing with it. At the end of the year, they'll see how much is the M3 in the banking system. How much did we initially print? So how much is the money multiplying? RBI will know. Let us say we arrive at a value of 4, as in this case. Next year, the RBI and the government together decide that we need to increase our economy by 100 rupees. The GDP has to increase by 100 rupees. We know that the money multiplier is 4. So what will they do? In order to increase the GDP by 100, which means from 400 it has to become 500, from 100 this will become 125. 25 will multiply 4 times and become 100. Okay, I'm using the same examples for the sake of continuity from there. Someone asked me earlier, is 25 rupees the multiplier? No, 25 rupees is the high powered money. In this case, 25 rupees is the high powered money or base money or reserve money. What is the multiplier? The value by which it multiplies. In this case, it multiplies by 4 times. If this is 500, it is multiplying by 5 times. If it is 800, it is multiplying by 8 times. How will we get to know? By calculating M3. That is the reason why we learnt M1, M2, M3. M0, M1, M2, M3. Okay. This is the concept of money multiplication. Okay. This gives an idea to the RBI how much more money is required in the economy. Just because we are going to produce 10 more goods worth 100 rupees, it doesn't mean RBI has to print 100 rupees. If 100 more rupees is required in the economy, you divide that by the money multiplier. Next year, 100 rupees is required in the economy. We know that, let's say the money multiplier is not 4, the money multiplier is calculated as 5. So the RBI will not print even 25. The RBI will print only 20 rupees. So M0 will be 20. M0 is the actual amount of money that is printed by the RBI. How much money to print is determined by your M3 divided by the money multiplier. I hope this is clear to you. Okay. If this is clear, Magesh, thank you. I noted it. It was realistically not possible for me to break it in between at 4:30 and give a break at that point of time. That is why I extended. I know that both the classes are mine. That is why both the classes are mine, right? Next session is also. That is the reason why I will give you a half an hour break. Just some adjustments here and there. We do have 6 minutes till 5 o'clock. So treat that as the time. 5 o'clock is when I'll give you a break. If you have understood this, there is one small bit left to teach in this topic. I'll finish that in 5 minutes and I'll give you a break then. I'll take up doubts also at that point of time. So this is money multiplier. We have learned what is money multiplier. There is one small topic which is not very relevant from UPC perspective, but I'll teach it along with the flow. There is something called as liquidity aggregates. Like we said, monetary aggregates, there is something called as liquidity aggregates. I am not going to go into the depth of this. I am just going to simply explain 3 terms: L1, L2, L3. Okay. L1 is equal to M3 plus post office, money in the post office. Okay. Money in the post office. L2 is equal to L1 plus money in non-banking financial institutions. L3 is equal to L2 plus money in non-banking financial companies. Okay. We already know bank is not the only place where money aggregates. Okay. But bank is the only entity which is entirely regulated by the Reserve Bank of India. So when Reserve Bank of India makes some policy decisions, honestly, it cannot take into account how much is the money in post office because it doesn't regulate the post office. How much money is in LIC or SIDBI because RBI doesn't regulate that. Or how much money is in Sundaram Finance or those Muthoot Finance and all those because RBI doesn't regulate those. So we stopped the money multiplication formula with M3. But the reality is money is available in other places also. So RBI says, anyway, we are accounting all these. Why don't we account some more aggregation of money? Now, what sort of aggregation? Here we are looking at liquidity. Liquidity means from a business's perspective. Okay, a business which wants to expand its production is asking a question, where can I get my money from? The answer is the business can get the money from banks. Okay, the money that is available in the banking system and in the entire economy is represented by M3. In addition to the money in the banking system and in the hands of the people, we also have money in the post office. In post office, there are some savings deposits which are offered, and there is a lot of small level of saving schemes which is offered in post office. Okay, so there is money available. That money is available for investment. Okay, however, when we talk about money in the post office, it is normally people who do not have access to other banking systems who deposit money in the post office, which means that generally it is the poorer segment of the population who deposit money in the post office. Not always, generally, majority of the population. It is very, very necessary to protect that money, which means that even though there is money available in the post office, not everyone is allowed to borrow from the post office. Mostly it is the government which borrows money from the post office. Government itself will borrow money from the post office, use it for its needs, and repay it to the post office after a period of time. So although this money is available, its liquidity is limited. So lesser liquidity, L1. Slightly more liquidity, L2 is equal to L1 plus. Where is more money available? Your government owned non-banking organizations like LIC, like Small Industries Development Bank of India, like National Housing Bank. These are all government owned entities which have a lot of money. From there also borrowing can be done, but because it is government owned, once again there is a lot more restriction with respect to how much money can be borrowed. It is easier to borrow from NBFI compared to post office, but it is still difficult compared to the third one, the highest liquidity. L3 is equal to L2 plus. What is NBFC? Privately owned non-banking financial institutions. That is the difference between NBFI and NBFC. In general definition, NBFI, NBFC, post office, everything will come under the same heading of non-banking financial company. But for the sake of classification, we are saying post office separately, government owned large institutions separately, and privately owned non-banking institutions separately, because from here borrowing money is very, very easy. It is the highest liquidity because government doesn't have any constraints. It is up to the private entity to decide where to give a loan, whom to give a loan to. So it is easier to get a loan from this place. So this is the highest liquidity that is there. Okay, this is purely with respect to where is money stored in the economy in addition to the banking system. That is where you learn about liquidity aggregates. If you want to actually learn the term, you can Google and learn. I have just given it in a way which is easy to understand. Even this is classified in this way. So I have used a lot of terms here, right? Time liability portion and all this. I could have simply said money with the banking system. This is also like that, but because this is a less important topic, I'm just giving you an idea. L1 means bank, M3 plus post office. L2 means L1 plus non-banking financial institution, and L3 is L2 plus private non-banking financial institutions or NBFCs. That is how you have to learn. So with this, we have completed the chapter on money. Okay, we will take a break now, but before going, I'll just I'm reminding myself and reminding you, there is a small portion of public finance which is left. I told you I'll teach it after the money chapter is over, before I go on to the next chapter. So I'll start with that after the break. Time is 5 o'clock. We'll take a break till 5:30. We'll start at 5:30. Class will not go till 8 o'clock. Class will end at 7:30. Don't worry. 5:30 to 7:30 will be the class. It will only be a 2-hour session. I apologize if someone had a plan during that break time. Sorry about that. But because I was in the flow, I extended the class. That is to be expected when I am taking the class. Just a warning for future classes also. Okay, I am very, very fluid with respect to time. So keep that in mind. Thank you. Half an hour later, we'll meet again. If you have questions, you can drop in. Okay, we'll take up questions at the beginning of the next class. I don't want to break eat into your break. Please type in your questions and send it again in the next class, because I'll be disconnecting right now. I have some unanswered questions. I'll take it up at 5:30. Okay. Sarah asked a question. I think Archana asked a question a while ago, and Lalit Kumar has asked a question. I think Lalit Kumar's I have answered. Difference between NBFC and NBFI. One is government owned, one is private. The other people's question, I'll take it up when we meet again after the break. Thank you. All right, we'll restart, but there's a slight issue. I have not been given co-host access yet, so I'll not be able to read messages that you sent, nor will I be able to see your video or respond to any hand raise. But in the meanwhile, I have a screenshot of some of the doubts that you had asked, so I'll start answering that. I hope you are there. Can someone come on video and give me a thumbs up if I'm audible and visible? Yeah, perfect. Okay. Thanks, Archana. Now, to answer the questions that were asked, all right. So the questions were, what is the difference between NBFC and NBFI? It was asked by Lalit Kumar. Just checking if Lalit is there. Yeah, Lalit is there. Lalit, I think I answered it already. Yeah, I have the co-host access as well now. So you can type in questions also. But I have the previous questions. NBFCs are privately owned non-banking financial entities, and NBFIs are government-owned non-banking financial entities like LIC, Small Industries Development Bank of India, National Housing Bank, Export-Import Bank of India, all those. Okay, so that's the difference between the two. Rini has pointed out, Rini's first message for the day, I think. She has pointed out that NBFCs are regulated by RBI. See, NBFC is like a huge ocean. There are some NBFCs which are regulated by RBI. Yes, there are some NBFCs. A lot of NBFCs are not regulated by RBI. Some are regulated by an organization called as SEBI, Securities and Exchange Bureau of India. Some NBFCs are regulated by the state government. Chit fund companies are examples of that. Some NBFCs are regulated by Ministry of Corporate Affairs. So NBFC is a huge area. Some are regulated by RBI, yes, but not all are regulated by RBI. Some are regulated by Insurance Regulatory Authority of India, right? So that is to clarify the point that Rini asked. In general, when you say NBFC, although some are regulated by RBI, most of them are not. Okay. All right. Sarah had asked a question. Just checking. Okay, I've answered Rini. Okay, to answer Sarah's question, Sarah, you asked me to repeat what is recurring deposit. It is the same concept as fixed deposit. In fixed deposit and recurring deposit, both these are term deposits where you deposit some money into your account with the assurance that you are giving an assurance to the bank that you will not come and ask for that money or withdraw that money for a period of some predetermined period. It could be 3 months, it could be 6 months, it could be 9 months, 1 year, 2 years, 15 months. All these options are there. All right. So that is what is a term deposit. But within the term deposit, there is also another classification. Are you going to deposit one huge amount and then keep it idle over there? Or if you are someone who doesn't have that huge amount of money, you might think, okay, I have 10,000 rupees to spare every month. Let me put 10,000 rupees this month and then 10,000 more rupees next month and then 10,000 more the month after that. You may not have 1 lakh in one go, but you will save 10,000 rupees over a period of, let's say, 12 months, and you will have 1 lakh 12,000 or 20,000 rupees. Okay. So reoccurring, repeated deposits, reoccurring deposits is what is RD. That is what is RD. That is how it is different from FD. In FD, there is only one deposit. At the time of creating an FD account, whatever amount you put, that's all. You cannot add to it. You cannot withdraw from it. You cannot say, I put 1 lakh rupees, I'll just take 10,000 out of it. The remaining 90,000, let it be there. That is not allowed. The entire amount has to be there. Okay. And to give you a little more clarity, be it FD or RD, in both the cases, you do have the permission of taking the money before the period. So it is not like you put for 1 year, you can never take it. You can take it, but then you will have to pay a penalty because you are violating the terms of the agreement. You will be paying a penalty, and penalty will be in terms of reduced interest. If they promised you 6%, they may give you 4% or 3% interest. That is all that they'll do. Okay. So you can take that money, but in general, there is an assurance, there is an agreement between you and the bank that you will not come and ask for it. That is, I have repeated recurring deposit. Correct. All right, a couple of other questions. Archana asked me a couple of times, can you please explain the outflow of foreign currency, how it determines? See, outflow of foreign currency has a role to play. See, there is, let's say, $100 coming into India, okay, and there is $100 leaving India. Now, how does dollar come into India? Maybe if an Indian exports some goods, they will receive dollars. Similarly, if an Indian imports goods, they will have to pay dollars. So paying dollar is outflow of dollar, and receiving dollars is inflow of dollar. If $100 comes in and $100 go out, in simpler terms, if the dollar supplied into India, what is supply? Someone earns it and comes and supplies it within the economy. If the dollar supplied in India is equal to the dollar demanded in India, who demands dollar? Someone who wants to use the money for international transaction, they're going to go to a bank and demand a dollar, using which they can buy things from outside. So import. So there is supply of dollar and demand of dollar. If the supply of dollar is greater than the demand for dollar, demand is outflow of dollar and supply is inflow of dollar. If the inflow is greater than the outflow, then there is excess money in the country. There is already, let's say, 100 rupees in the economy, and then there is $10 extra. That $10 extra has also been, should be converted to Indian rupee. So whatever is the equivalent of the $10, that has to be printed as new money. That is the third reason. I hope that is clear, Archana. Okay, perfect. Then Jawahar asked a question: are Google Pay, Paytm examples of non-banking financial intermediation? No, these are services which are provided. These are not non-banking financial. These are not financial intermediation at all. In Google Pay, you are not going and giving money. What is financial intermediation? An institution which takes money from you, which borrows money from you, gives you an interest, and gives it to some other completely different person. The bank will decide whom to give it to, or a non-banking entity will decide whom to give it to. Google Pay doesn't do that. It is just a platform in which you can pay money to someone else. It is just a platform. That is not a banking service. That is just a financial service that is provided. Paytm is also an example similar to that. These are various business platforms which are provided where you can transfer money from one. It is just like a website of a bank. Your Google Pay or your Paytm is just like your, if you have a bank, your bank has a website, or your bank has an app. It is just like that. Instead of using different bank accounts, let's say you'll have to go to 3 different apps and use it. Instead, Google Pay or Paytm or any of these will allow you to merge all of those into one entity and use it for transaction. That is all that they are doing. They are not a bank themselves. Of course, with Paytm now, they have their own version of a bank. Paytm Payments Bank is there. That's a different entity. Then they are recognized as a bank. Okay, so that is the difference. I hope I clarified it for you, Jawahar. And Sarah, you said, so according to the example, 25 is the money multiplier. I hope I have clarified it for you. 25 is not the money multiplier. 25 is the base money on which money multiplication happens. I hope that is clear. If you have any further questions, you can ask me now. In addition to these. Okay, Sarah is asking, sir, could you please repeat RD? Okay. Yeah, I think I have done both of it, Sarah. I hope that is clear. Sir, what is the effect of black money on money multiplier? Black money doesn't have, see, the impact could be, I think when you say black money, the moment you say black money, it doesn't go into the banking system. If it doesn't go into the banking system, there is no money multiplication happening. So if there is a lot of black money in the economy, the money will not multiply, because the money is just transferring from one hand to another hand within the economy. It is not multiplying at all. The physical currency has to be maintained for it to be black money. So black money prevents money from multiplying. That is the impact. Lalit Kumar, hope, not Lalit Kumar, sorry. Ragul, hope that is clear. Black money has a effect of not multiplying money. Sir, I can't get FCNR account. Does the deposit in denomination of foreign currency? Yes. If you are residing outside India and you are depositing money into your FCNR account, let's say you are depositing money from London, your money will be denominated in pounds. If you are depositing it from some European country and you are depositing euro, it will say you have this many euro in your account. Inside India, you will have a bank account in which the money will be denominated in foreign currency, not in Indian currency. That is FCNR. Lalit, hope that is clear. Tanuja, minimum deposit. See, Tanuja, I don't know if you have an account of your own. I assume you have an account of your own. If it is not a salary account, if it's a normal account which you have opened in a bank, okay, I don't know whether you are an employed individual or not. If you are employed and this is your first account, if you have a bank account, there is a very good chance that yours is a salary account, so you don't have to maintain any minimum balance. But for a common man who opens an account, or if you yourself go to a bank just to open an account, they will have a condition that at any given point of time, a certain amount of money has to be retained in your bank account. That is called as minimum balance requirement. Hope that clarifies it. Jawahar, I think I have answered that question. Can you explain the difference between NRE and FCNRB account? Yes, Vamshi. The difference is that in NRE account, the deposit is denominated in rupees, in Indian rupees. The interest calculation will be on Indian rupees. Whereas when we talk about FCNRB account, the denomination is in foreign currency. The interest calculation will also be on the foreign currency. Some countries only have digital currency. Is it possible in India? Kishore is asking. No, Kishore, I don't think there is any country in the world which has only digital currency. I don't think there is any country. If you can give an example, I'll read about it. Is it possible in India? It is possible, Kishore, but think of it. So I assume when you say digital currency, you are referring to Indian rupee being used in digital form, not about cryptocurrency, not about bitcoins, Kishore, because we discussed the difference between these in the last class. Is it possible to have an entirely digital economy in India, digital currency in India? It is possible, but imagine that some satellite which is providing internet to India up there in the sky, let's say it collapses. Worst case scenario, let's say it collapses. Or we have an acute power failure. The power plants in India fail for some reason. It won't happen, but imagine such a scenario. Everyone thought something like COVID would never happen, right? So imagine a scenario like that. Then the entire electricity will fail, internet system will fail. Then how will you use money if everything is digital? Which is why after demonetization, everyone was talking about cashless economy. Cashless economy. Soon we realized that cashless is not a reality. It is not a realistic scenario. So they moved to a less cash economy. Just a change in position of the letter. But cashless means no cash. Less cash means less quantity of cash. Most of them being digital in nature. We can be a less cash economy, but cashless economy is not a realistic possibility because of some reasons. Some people prefer to keep their money in the form of cash. In rural areas, the penetration of internet is still very low. Even in urban areas, the older generation is not well versed with technology. So you cannot expect everyone to compulsorily follow digital currency. Okay, so all these are certain issues. And since financial literacy is low, there is a very high chance that money could be siphoned off from your account. There could be a lot of digital theft of money, and all those could become an issue. Okay, so it is not a likely thing to happen. Is it going to be a completely digital economy? I don't think so. Okay, sir, what is the source of income for UPI payments like Paytm, PhonePe? They may charge for your transactions or through advertisements maybe, or with Google Pay. Let me just think. With Google Pay, I don't know. Actually, you should look at the business side of it. I don't know what is their profit, how they get their profit. I have no idea. Maybe through advertisements, possibly. I don't know. I'm not very sure about source of income for them. I don't know. Okay. Archana is asking, sir, even M1 prevents money from multiplying, right, sir? But still, as opposed to black money, why is it used to calculate money multiplier? The simple reason is this: whatever amount is in M1, that is also part of the Indian economy, right? Money inside the economy, that is accounted. So when we say there is 400 rupees in the economy, when I printed 100 rupees, this 400 should include the money that is in the hands of the people, money that is there as demand deposits also, right? Because that is also money that is there. That is the reason we add that. But why we do not add black money is because it is unaccounted money. It's illegal. How can we give recognition to black money? But although they do not count it, RBI will take into account that some level of black money or some level of fake currency exists in the economy. So they will consider that also in their internal discussions. they'll say other factors. Other factors will include these. But for our calculation, that is not necessary, because then it is like giving recognition to black money. Okay. All right. So that is about Archana. That is Archana's question. I heard long back it's cashless economy. Sweden says no. I don't think that is true. It by cashless, what they meant is less cash economy, because for a long time cashless was used to refer to less cash economy, right? Where very little cash is available. That is possible. Even India is moving into a lesser cash economy when compared to previous year. Compared to last year, we are using lesser cash. Compared to this year, next year, we are likely to use lesser cash, because more and more people are going for digital payments. Especially with this COVID, people are very hesitant to use physical currency anymore, because COVID could transmit through that. So people are moving for digital transactions. Okay, so that is there. Tanuja is asking for what purpose we should have minimum balance. Tanuja, I explained this part as well in class, but I'll repeat. Banks incur some expenditure in maintaining your account. So it should not be a case where you will just open an account and leave it as a zero balance account. So because the bank is incurring some expenditure, they expect you to at least have some money, so that there is some deposit, some lending, something of that sort happening. Your account should be active. So the banks don't have any way of ensuring that your account is active. So they say have some minimum balance, so that at any given point of time you will come back to this account. Otherwise, what will happen is a lot of times people will open an account, then they'll think I don't want to use a bank account. They'll not close it. They'll leave it like that and they'll go. They'll never use that account, which will mean that the banks will have to keep on maintaining that account without getting anything in return for that. That is the reason why banks say have a minimum balance in your account. And when it comes to salary account, there is an assurance for the bank that at the end of a month, every month, there is going to be money deposited into that account. So they say it is okay even if you don't maintain a balance, because the account is going to be active. Okay. Hope that is clear. Now we will start with, see, the next topic is inflation. But before we get to inflation, there is some leftovers from public finance. Can someone tell me what exactly the leftovers from public finance was? Is it about debt creating capital receipts, debt capital receipts, different types of borrowings in debt capital receipts? Please confirm if this is this. This is what is left. Okay. Thank you, Archana. So debt capital receipts, which is government's debt, which is how much ever fiscal deficit that they have, they are falling short of money, so they need to borrow. These are the two major sources from which they borrow. Okay. There is also one more source. Okay, I'll talk about it here in internal borrowing. The government could borrow. First, I'll talk about internal borrowing. Number one, the government could borrow from public. Okay. So when I say public here, it is in public finance. In public finance, the word public means government. But here I'm saying in external borrowing, sorry, internal borrowing, the government could borrow from public. I mean households plus businesses. That is what I'm referring to as public over here. Please note it very specifically, because in this very chapter, the heading public finance, public refers to government. But here I'm by public, I mean household plus business. Government could borrow from household or businesses. Here business, in this case, business includes banks also. Because here there are two entities. There is government, okay, three entities. There is government, there is RBI, there is public. In this scenario, there is government, because we are talking about government's finances, right? There is government, then there is government's banker, which is RBI, and then there is the public. So here the public includes household plus businesses. In this, the business includes banks also. Banks and other institutions, financial institutions, plus companies. All of them would be included here in public. All right. So that is public. Government could borrow from public, or government could borrow only from businesses, and not any business. Let me rephrase it. Government could borrow from financial institutions. Financial institutions. Financial institutions include banks plus non-banking financial companies. Banks and non-banking financial companies. The government could borrow from other internal sources. I'll expand on this other internal sources. And finally, the government could borrow from, as a last resort measure, it can borrow from Reserve Bank of India itself. Yeah. See, normally when we talk about public, yeah, public lends money not with the motive of earning a profit. Public lends money with an objective of saving. Okay, they want to save the money for future. If they happen to get a profit out of it, well and good. All they want is they shouldn't have a loss of value of money. They have 10,000 rupees with them. 5 years later, if they access the 10,000 rupees, it should have grown sufficiently to deal with inflation, maybe a little more. That is all that the public is looking at. The objective of public is never to make a profit, huge profit out of it. Their objective is to save. And when we talk about objective being saving, their objective is not short term in nature. The objective of saving of a household tends to be long term in nature. So this is a long term borrowing. The borrowing from here is long term in nature. Okay, it is by issuing what we call as government securities. Or GSEC. Okay. Whereas financial institutions, when they give a loan to the government, their objective is not to save their money. Their objective is to make a profit out of it. Look at the name, financial institution. Their whole idea is to make money by giving loans. So their objective is profit. They want profit in the short term. So short term borrowings of the government happens primarily from financial institutions through an instrument called as treasury bills, shortened as T-bills. Okay, I have written other internal sources separately here to show that government is borrowing from people indirectly also. Okay, again the instrument used here would be government security. It will be long term in nature, but government is borrowing people's money, but not from people. So how does that happen? You have heard about a concept called as provident fund or pension fund. All these are things that we hear, right? What is a provident fund? It is similar to a pension fund. So you all know pension fund, where we contribute some money, we keep on contribute throughout our work life, so that when we retire, we have some form of earning. We have accumulated some money and we start earning something out of that. Yeah, that is what is a pension fund. When we contribute towards that, the money goes temporarily into an authority called as Pension Fund Regulatory and Development Authority of India. Okay, that authority is the one managing that fund. That authority will have this money. They cannot keep that money idle, right? They have to make the money grow. Only then they'll be able to repay the pension. They'll not keep the money idle. So what they'll do, they will give this money as a loan to the government of India, because that is the safest bet. They will use this money to give a loan to the government of India. Similarly, we have Provident Fund. What is Provident Fund? You are saving some money, not for after retirement, but before retirement itself. If you have some urgent expenditure, some medical expenses or marriage or education or something like that, you are saving some money which you can withdraw during your work period itself, work life itself, or you are suddenly out of job, you don't have money for survival, you can withdraw that money and use it for your current requirements. Okay, that is Provident Fund. All this money is money with the hands of the some organization of the government, but it is some organization of the government, not directly with the government. So government can borrow from this organization and use that money as well. This is how government indirectly borrows from us. That is other internal sources. That is also done through government securities. Okay, so this Provident Fund and Pension Fund and National Small Savings Scheme and all those are called as other internal liabilities of the government of India. That will directly not come under as debt of government. When we deposit money in our pension fund or Provident Fund, it will not come as debt in the government of India. But when the government borrows from that entity, that will come as debt. That is a part of internal debt. That is why I have written other internal sources. Okay, so that is other internal sources. And from RBI, okay, see, prior to 2006, whenever the government of India required money, they will simply go to RBI and say, print some money and give it to me. But we have already seen that that is not how money supply has to be managed in the economy. What will happen if there is too much of money in the economy, more than required? It will lead to a situation called as inflation. And if there is far too much money, whenever government requires, RBI will print money, will lead to a situation of hyper level of inflation. It could lead to a situation like that. So to prevent that, from 2006 onwards, there are strict rules which prevent the government from asking or borrowing directly from the Reserve Bank of India, which means government cannot issue GSEC or a T-bill directly to the RBI. They cannot issue a GSEC or a T-bill to RBI and borrow money from them. It is not possible. Okay, so government cannot borrow directly from RBI, but still the RBI has some responsibility as the banker of the government of India. So the RBI says, if there is any urgent expenditure need of the government of India and it doesn't have money, the RBI can give loans for that current expenditure requirement with a validity of 3 months. They can give a loan up to 3 months where the money has to be repaid within those 3 months. Okay, government can borrow and has to repay within 3 months. Okay, it's a temporary facility provided where the government can borrow money from RBI, but for their current sudden expenditure needs, which is called as, so it is extremely short term. This is called as ways and means advances. Just as an extra information, both central and state governments can issue GSEC. Both central and state governments can issue GSEC. When the state issues, it is called as state development loans. Okay, T-bills can only be issued by the central government. Short-term borrowing from the market can be done only by the central government. Ways and means advances, which is borrowing from RBI, can be done both by the center as well as the states. This is just factual information for you. All right. Now, a little more information about GSEC. a little more information about GSEC and T-bill. So GSEC, imagine a bond paper like this with government symbol and all those. Yeah, that creature is supposed to be the emblem that we have. Please don't. It's like my India map. You have all seen my India map, right? So this is much better than that. So you should not complain. Looks like a hat of a chef, but that's okay. Anyway, so the key point is, in this particular document, which we refer to as a government security, or a document which gives information about the terms of borrowing, we will have the principal amount. How much was borrowed? Rupees 1000 is borrowed by the government for a period of, let's say, 2 years. N, okay, which is the duration, at a rate of interest of, let's say, 7% or, okay. It will also have the date on which the borrowing is done, which means if it's for 2 years, it will also be very clear on what date will the money be given. Okay, this is a paper which has a government seal which says that this much amount has been borrowed, and these are the terms. This is the duration for which I am borrowing. This is the rate of interest that I am going to give you. This is a government security. Okay. Now this, because it's long term, we are going to refer to it as a government security. There is also another type of government security. The same hat of a chef here. Okay. So this is a T-bill. This is a T-bill. Now what is a T-bill? How is it different? T-bill is a short-term instrument. I've already told you that. What is short-term? What is long-term? Greater than 1 year. 1 year or greater, actually. 1 year or greater is GSEC. T-bill is less than 1 year. There are T-bills of 3 different maturities. Maturity is the duration for which the loan is taken. There is a less than 1 year, right? What is less than 1 year? 1 day less than 1 year. There is a 364-day T-bill, half of it, which is like a 1 year T-bill. There is a 182-day T-bill, which is a 6-month T-bill, and there is a 91-day T-bill, which is a 3-month T-bill. There are 3 durations in which the government borrows money from the financial institutions in the short term. Either they borrow for 1 year or 6 months or 3 months. That's all. There is no other duration here. Okay. You would have already studied as part of your school mathematics and all those. This PNR by 100 and all those. There, the interest is generally calculated annually. Interest is generally calculated annually, right? But here the duration itself is less than 1 annum. Okay. So what do we do in such cases? Now, instead of following the interest rate method, here the method of calculation is through interest rate. They are using a different methodology over here. Okay. I'll explain the methodology, then I'll tell you the name. So here the government says, the government doesn't say how much they are borrowing. Here they said how much they are borrowing. Here the government said how much money they borrowed. Here they will not say how much money they are borrowing. They'll say, I'll give you 2000 rupees at the end. I'll give you 2000 rupees at the end. So that is what they'll mention in this security. This is also a security. Just that it has a name GSEC. This is also a security if you think of it. Okay. In the T-bill, they'll mention 2000 rupees will be given to you after 91 days. That's all. They'll have the date over here. Okay. There is no mention of how much did the government borrow. So when the borrowing is initially initiated, the government will say, I am going to sell a 2000 rupee 91-day T-bill. In order to give this, I need a minimum of 1600 rupees from you. This is not mentioned in this T-bill. They'll advertise, the government will advertise saying, I want to borrow, I am going to sell 2000 rupee T-bills with a 91-day maturity. I am okay if you give me 1600 rupees, I'll give you this. Then the government will say, now I am going to conduct an auction. Whoever wants can come and buy. 1600 rupees is my price. Now you tell me your price. So if there is a high demand for this T-bill, what will happen is that someone will say, I'll give you 1650 rupees. Someone will say, I'll give you 1700 rupees. Someone will say, okay, I want it for 1,800 rupees, and no one else is quoting a higher price. The government will say, sold to you. You take this 2,000 rupee bill, you give me 1,800 rupees now. After 91 days, I'll give you 2,000 rupees. There is no concept of interest rate. What is the gain? The person bought it for 1,800 and will give it back at 2,000 rupees. The 200 rupees is the gain. The 200 rupees is the gain over there. There is no concept of interest rate. Based on whatever is the buying price, the profit will be determined. The higher the buying price, the lesser will be the profit. Okay, if this is bought at 1,900 rupees, then gain is only 100 rupees. If there is very low demand and no one bids at a price higher than 1,600, then it will be sold at 1,600 rupees. 400 rupees will be the gain for that whoever is buying it. Okay, this particular concept has a name. It is called as issued at discount. So this is the issue price. This 1,800 is the issue price. Issue price is a discount compared to what? Compared to whatever is the value mentioned on the T-bill. Okay, issue price is lesser than whatever is the value mentioned on the T-bill. So issued at a discount. Issued at discount, redeemed at par. Redeemed at par. Par means equal. Par value means equal value. Equal to what? Redemption. Redemption means I am going to give this and redeem my money. How much am I going to get? Whatever is mentioned on this, that much amount I'll get. Issued at a discounted price, redeemed at par. Okay. But this one works on the concept of interest rate. This one works on the concept of interest rate. I hope this is clear. See, with respect to ways and means advances, I've already told you about this. When we learned about FRBM in 2006, FRBM Act prevented the government from monetizing their deficit, which means that they cannot borrow from RBI directly. The only way in which they can is temporary borrowing in the method of ways and means advances. Okay, so it is very similar to, I don't know if you have heard of something called as an overdraft facility. Overdraft facility in a bank, where you might have only, let's say, 1 lakh rupees in your account, but because you have a prior agreement with the bank will allow you to withdraw even 1,50,000 rupees. Let's say you have an overdraft of 50,000. What it means is that you can withdraw 50,000 more rupees than is available in your account. You only have 1 lakh rupees, you can still withdraw 1,50,000 rupees. So it is like a loan which the bank is giving you without any paperwork required. Pre-approved loan. It is like a pre-approved loan, that overdraft facility. This is also like that. Government has a certain amount of money with the RBI, and the RBI says a certain percentage of this you can withdraw as overdraft facility. Even if you do not have money here, you can withdraw it. So this ways and means advances is exactly like that. It is not even like a loan, it is like a pre-approved loan, automatic process. Okay, so there is nothing else that I have to teach over here. In internal borrowing, we still have external borrowing left. So internal borrowing is done. We have external borrowing. In external borrowing, it is not really important who the government borrows from. The government could borrow from other countries. So this is bilateral borrowing or international organizations. Like we could be borrowing from IMF or World Bank or some other entity like that, or Asian Development Bank. Any of those we could be borrowing from. That's not what is important. What is important is the methodology of borrowing. With respect to international borrowing, there is always one major issue. Okay. Exchange rate. Now consider this calculation. Let us say we are borrowing from USA. We are borrowing, let's say, not rupees. Let's say we are borrowing $100. Let's assume we are borrowing $100. India is borrowing $100 from USA. On the day of borrowing, $1 is equal to, let's assume 70 rupees. Okay, so it means that we'll end up borrowing 7,000 rupees. India will say we'll give you an interest of 10%. So this will be 7,700 rupees. So 1 year later, let's say it's for a 1 year period. 1 year later, we give back 7,700 rupees. We'll be giving $110. At 70 rupees to $1, it will be $110. No issue so far. Okay, if the government had borrowed from domestic sources, they may have had to pay 11%. Instead, they are getting a loan at 10% from a foreign entity, so they'll borrow. But the problem comes here when on the date of repayment, the dollar is equal to 80 rupees, let's say. Okay, and the foreign country is giving you a loan not to give 10% on 7,000 rupees, but to give 10% on $100. So it's $110. If the dollar exchange rate is $1 is equal to 80 rupees, it is not 7,700 rupees that you have to repay. It is 8,800 rupees that you have to repay. So the government looks at it and says, why did I go to the trouble of borrowing from abroad? I could have borrowed at 11% domestically, so I would have got a better deal. Okay, the government could have got a better deal by borrowing domestically. So this is the situation. This is the problem with external borrowing. So to overcome this problem, there are a few methods. Number one, there could be something called as historic rate of exchange agreement. An agreement to use historic rate of exchange. Okay. What is historic rate of exchange? Whatever is the rate of exchange on the day of borrowing, using the same rate of exchange on the date of returning. Okay. Historic means on the date of repayment, that is history, right? 1 year ago is, or 2 years ago is history. Using the rate of exchange prevailing on the date of borrowing for the purpose of repayment of loan, that is called as historic rate of exchange. Okay. But if you notice carefully, in our earlier example, if we use historic rate of exchange, USA is suffering a loss. If you give 7,700 rupees, when the exchange rate is $1 is equal to 80 rupees, they are getting less than $100. They are suffering a loss. Now we would ask a question, why would they do that in the first place? I'll answer that question along with some other points. Now let's look at the second way in which this exchange, second thing to learn in this external borrowing. If not this, there is another way in which the government could get into an agreement. The government will say, let me borrow the money for a long term. When I say long term, I'm not saying 1 year, 2 years or 3 years. Let me borrow money from you over 30 years or 50 years. Okay, you give me some money, I'll repay the money over the next 30 years or over the next 50 years. What will happen? The present obligation of repayment will reduce. You're taking a huge amount, you are dividing into 30, which means over 30 years I have to pay small amounts, which means over inflation and all those, it will adjust. Okay, it will get adjusted. It will not be as much of a problem to deal with that loan. That is another strategy that we use. Or we might say, use a discounted interest rate. I'll borrow from you, I'll give you the existing rate of exchange, but I'll give you an interest rate of only 1%, 2%, 0.5%. Okay, you take the bullet train project. Okay, Japan is sponsoring the amount required for implementing that project. Japan is the one which is doing that. They are giving us the money, they are giving us the technology also. Okay, they said, I'll give you a loan. I think the loan is for 30 years, if I'm not wrong, maybe even 50 years. They also said the interest rate will be as low as 0.5%. That is all the interest. The normal banking system charges an interest of 12% for loans, 10 to 12% or 14% for loans. They are charging 0.5%. So discounted interest rate borrowing. Okay, that could be the mode. Sometimes it is 0% interest also. We'll give a loan, we'll say no need to pay interest, just repay the principal amount. Or we might take a loan where we'll say we'll only give back the principal amount, no interest at all. Any of this could happen. Okay, now the question is, these three scenario leads to a loss for the lender. USA is giving us money, it could lead to a loss for USA. Why are they still doing it? Very simple. USA will say, I have given you money. Now in the international forum, if ever there is a trouble, you come and support me. If I impose a sanction on Iran, you also impose a sanction on Iran. If I make a declaration in United Nations, you support me there. Or it may not get into all these things. It will say, I have given you this discount, my business people will come, you allow easy investment for them. Or like in the case of Japan, Japan will say, I'll give you a loan. The only condition is you have to give the bullet train project to a Japanese company. You cannot give it to your own domestic company or a Chinese firm. We'll give you a loan if you give a project to the Japanese company, which means their company stands to gain out of it. Okay, it could be any of these. That could be the reason behind them giving a loan like this. So if they give a loan like this, it can be considered as external aid. It is a sort of help that we are receiving from them, reduced terms of borrowing. Do not be under the impression that external aid means money that they give which we need not repay. That is called as grants in aid. External grant, grants in aid. That's grant, G-R-A-N-T, grant. But this is external aid. This is loans at concessional rates, loans on concessional terms. I know I'm not visible, but yeah, if you have any questions, you can ask. Meanwhile, I'm done with teaching this external aspect as well. So the public finance, whatever was left over, I hope I have not repeated the concept. I don't know if there is any repetition from what ma'am has already taught. I hope I didn't waste your time. But this is all that is there that was left over. Okay. Now we'll move on to the next topic, which is inflation. Shall I start? Okay. There is a doubt which has come in. Archana says, can you explain ways and means advances with respect to overdraft concept? Archana, if you have a bank account and the bank is providing an overdraft facility, it means that if you have, say, let's say you have an agreement with the bank that you have an overdraft facility of 1 lakh rupees, overdraft facility of 1 lakh rupees. Okay. They'll not give that overdraft facility to everyone. They will give it to some privileged customers. They will give it to some business people. That is why generally in current account, you will find overdraft facility. It may be there in other accounts, but generally it is available in current accounts for businesses who have a good equation, good reputation with the bank, where they have a good reputation of repaying loans and all those things. So there, the businesses, their logic is that it is not always predictable how much money they require for their business transactions. So sometimes they may not have enough money for their expenditure requirements. So when you don't have enough money, what you normally do is you go to a bank, you apply for a loan, you get the loan, you show proof that you will be able to repay, and you will get a loan. But this is a time consuming process. So what happens is the bank says for all your small needs, for example, you require immediate amount of money, and for a business 1 lakh rupees may be a small amount. Okay, their normal transactions are in 5 and 10 lakhs, so 1 lakh will be a small amount. So up to 1 lakh, I'll give you a loan without any approval requirement, and I'll grant a loan. You can use it anytime you want. So let's say you have 5 lakh rupees in your account, but suddenly your transaction requires 6 lakh rupees for some business transaction. So with only 5 lakh rupees in your account, you can make a transaction for 6 lakhs because they are giving you an instantaneous loan of 1 lakh rupees. This is called as overdraft facility. Very similar to that. Who is the banker of Government of India? Reserve Bank of India is the banker of Government of India. Okay. So RBI says you have this much money in your account. I know how much of money you are transacting on a regular basis. Now, if you want a loan, there are conditions which say you cannot come and directly borrow from me. You have to go issue government securities or T bills. You have to conduct an auction. You have to schedule a date. It is a time consuming process. You can get it. But for immediate needs, quickly you need money, and not huge amounts of money, small amounts of money you need quickly. You come to me, I'll give you a loan. Okay, as in a pre-approved loan. You need not even come and ask me. You can directly withdraw money. Just that you need to repay it in 3 months time. That's all. The same facility which an individual gets in a bank, the government gets from their bank. That is the facility. Okay. All right. So Tanuja says yes. I'm assuming you are saying that yes, I can start the concept. Start the next topic. Okay. Do you guys mind if I take a couple of minutes break? I'm feeling a little tired. That's why I'm sitting. I'm feeling a little short of breath as well. So just give me a couple of minutes. I think it's because I've been traveling a lot over the last week and a half. Went home and I had to travel a lot. So I'm feeling a little low on my energy. Just give me a couple of minutes break. 6:35 I'll start. Thank you. All right. So we'll continue. There's one question Sarah has asked. Sarah, I'll explain it at the end of the class, 7:30 or so. The money multiplier formula you want me to explain again, M3 by M0. I'll explain it. I hope it is only the money multiplier formula, not the entire monetary aggregates. Whatever it is, I'll explain it at 7:30. Okay, I don't want to do it now. So I'll start with inflation, starting with the index. First topic is introduction. So what is inflation? So we'll talk about that. We'll talk about what causes inflation. We'll specifically talk about one type of inflation called as structural inflation. We'll talk about spiraling inflation. Okay. See, a lot of these terms are very new for you. I understand that, but I'm just giving the heading over here. Spiraling inflation. So this will be followed by types of inflation. Then measuring inflation. As part of it, we'll be learning about price indices. The various types of price indices. Maybe you have come across terms like consumer price index or wholesale price index or things like that. So we'll be covering that. Okay. So price indices. This will be followed by effects of inflation. Whether it is good, bad, what are the effects of it on different segments of the population. And we'll also be talking about, since we talk about the effects, we'll talk about measures to control inflation. Okay, measures to control inflation. Within this, specifically, we learn about one concept called as monetary transmission, SSION, transmission mechanism. Monetary transmission mechanism. And finally, the last thing is terms related to inflation. Some random terms which are not in any particular order, but those are concepts with respect to taxation, so with respect to inflation, which is relevant for us. Okay, so this is the index for the chapter, starting from here, and then this. I hope you have written. Okay, I'll just wait for a minute or so. The people who are visible to me on screen, I'm using them as indicators. If I see them writing, it means I'll wait. So please don't act like you are writing. Okay, just when I sit comfortably, I see that you finished writing. Okay, so can someone define inflation for me? Text. Define inflation. Okay. So I have a few answers. One without a name. Again, you forgot to enter your name. You had added your name last time. The 208825. Please add your name. Forgot what your name was. Okay. So the answers are, okay, consistent rise in prices of commodities or persistent rise in price levels. Some keywords are important. Consistent, persistent, both mean the same. But in the first one, it says prices of commodities. The second one, it says price levels. Interesting distinction. And then Archana says general increase in, okay, the first, I don't know the name. Second one was by Vamshi. Archana says general increase in price levels of basket of products. Fair enough. That's very good. Actually, that is correct, but not entirely. Then Tanuja says loss of value of currency. Totally correct. Rise in price level. Rini says that's also correct. Extreme hike in price of essential commodities. Does it have to be extreme, Sri Lakshmi, for it to be called inflation? Gentle rise in price is not inflation. So that's a question that is there. Decline of purchasing power of a currency over time. That is correct. That is very similar to what Tanuja has said. I'll give you the definition. Okay. So I'll take a key point from a lot of the answers that have come in. So one word is, you can write consistent or you can write persistent. Rise in general price levels in the economy. It is generally measured on an annual basis, so you can write over a period of time or over a year. So persistent rise in general price levels in the economy over a period of time. If you want, you can write that over a period of time. There are some keywords here. We need to understand those keywords. Persistent. Rise, you all know. This is increase in price. Everyone knows. Everyone in this class, I've mentioned it over various instances. Vaishnavi ma'am would have mentioned in some of the previous classes. Inflation is increase in price. That much everyone knows. Okay. Persistent rise in general. Why are we using the word general here? Archana had sent a message saying general increase in prices of basket of commodities. Why have I used the word general here and not in the beginning? So that is a question. That's a very important. It's not easily replaceable. You cannot say general rise in price. There is a reason why we say persistent rise in general price levels. I'll focus on that. And it is not prices, but price levels that we are focused on. Not directly the prices of commodities, but price levels. I'll tell you why also. In the economy is fairly understood. Okay, we'll go one by one. Persistent. Okay, what is the significance? Let us say the price of 1 kg onion. Price of 1 kg onion today is, let's say, I don't know what is the price as of today. Let's assume it's 30 rupees. Okay, price of 1 kg of onion is 30 rupees. Let's assume. Now, let us say, because of the farmers' protest that is going on, in support of that, some lorry drivers decide to go on strike. Okay, some lorry drivers decide to go on strike for one day, or maybe for 2-3 days. They go on strike. 3 days. It's a planned strike for 3 days. Okay. So during that period, there is a sudden decrease in the supply of onion because no one is there to transport onion. Whatever onion is already there, that is all that is there. So what happens? 1 kg of onion starts selling at, let's say, 80 rupees per kg during that period alone. And once again, after 3 days, when the strike is over, the lorries are back, the supply is back, the price drops back to rupees 30. This is also an increase in price. Is this called inflation? We do not consider it to be inflation because we know it's temporary in nature. We know it will be overcome. So it has to persist over a period of time. It has to last over a period of time. That is what is persistent. The increase in price has to last over a period of time. That is what we mean by persistent. Rise, we know, is increase. Okay. So this general price level We have to learn these three together. First, we'll focus on the general part. The word general. Okay. Now, do we buy only onion or do we buy a combination of vegetables and other commodities? To answer the question, I know that the answer is very evident. We do not buy only onion. We buy a variety of vegetables, but it is not only vegetables that we buy. In addition to vegetables, we also buy groceries. In addition to groceries, we also spend on transportation. In addition to transportation, we also spend on our education. In addition to education, we also spend on our healthcare. We spend on technology. We spend on gadgets. We spend on entertainment. We spend on TV. We spend on going to the movies. All these are expenditures that are there. Okay. When we are talking about inflation in the economy as a whole, which is why I wrote the word economy. If we are talking about inflation in the economy as a whole, we cannot look at just increase in the price of one commodity alone. We cannot look at the price of onion and say there is inflation in the economy. No. We cannot even look at only vegetables and say there is increase in the price. Yes, everyone consumes vegetables. Okay, everyone consumes say rice. But just because the price of rice has increased in the economy, we cannot say that there is inflation. So everyone consumes food. Let's say uniformly the price of all food items have increased. Even then, we cannot say there is inflation in the economy, because let us say you were previously spending 10,000 rupees on food over a period of time. Okay, let's just assume you are spending 10,000 rupees on food. Today, due to inflation, you are having to spend, let's say, 15,000 rupees on food. Whereas previously on transportation, so I'll just write those numbers. Otherwise, I'll forget the numbers. Okay. Previously on food, you were spending rupees 10,000. Now this is past. In the present, on consuming the same set of food items, not increased food. If you are saying increased food, we cannot say price. So on consuming the same quantity of food, in the present you are having to spend, let's say, 15,000 rupees. Okay. Previously, in the past, on transportation, okay, transportation plus education plus entertainment plus, let's say, health, together, let's say you are spending rupees 18,000, or let's say 20,000. Let's round it off. Why write 18,000? And you are spending 20,000 rupees. Now, due to some reason, on the same commodities, in the present, you are having to spend only rupees 10,000 on the same commodities over here. The price has decreased here. Okay. So you say food is very, very important for us. Yes, agreed. 5,000 rupees more you are having to spend, but we do not consume just food. We consume other things also. So here what has happened is that there is a decrease in the price from 20,000 to 10,000. So overall, previously you were spending 30,000 rupees. Now you are spending only 25,000 rupees. Or let's not make it that way. Let's not look at, let's say you are having to spend 15,000 rupees here, which means previously also you were spending 30,000 rupees. Currently also you are spending 30,000 rupees. Just because the price of food has increased doesn't mean in the economy as a whole there is inflation. Okay. Is there inflation in the food sector? Yes. We can call this as food inflation. If the price of fuel alone is increasing, we can call it as fuel inflation. But if we are talking about inflation as a whole in the economy, we have to consider all our expenses together. We have to consider all our expenses together. Only then, if overall on all goods, if we have spent more, if we are having to spend more money today, then we can say there is inflation, which is the importance of the word general. General means overall in the economy, over a wide variety of goods and services that we consume. Okay. Now I have not finished general. So how do we actually measure this? It's very important to understand. Okay. Different people consume different things. Different people consume different commodities. Your requirements would be different, someone else's would be different, mine would be different. So how do we say with certainty that there is inflation in the economy or not? Because you may be consuming some commodity in which the price has dropped, while I might be consuming a commodity in which the price has increased. So there is that difference that comes in the economy. So to bring about a uniformity, what we do while calculating inflation is that we will create a sample set of goods and services. Goods and services. A basket of goods and services. A sample set of goods and services. Okay, I'll just give an example of a sample set of goods and services with 4 commodities in it. Okay, food, clothing, entertainment, housing. Okay, food, clothing, entertainment, and housing. Let's assume just I'm restricting it to just these 4. There could be more. Okay, just restricting it to these 4 for the sake of explaining the concept. Okay, so here what we do is we say that across the years in which we are measuring inflation, we are measuring inflation for 2015, 16, 17, 18, 19, 20, 21, 22. Across the years in which inflation is measured, we have to assume that the quantity of these consumed is remaining constant. Okay, why do I say so? Let's assume I spent rupees 10 on buying pen last year. Okay, I spent rupees 20 on buying pen this year. I bought pens last year at rupees 10. This year I'm buying pens at rupees 20. Can we say whether there is inflation? We do not know. Last year I may have bought 2 pens. This year I may have bought 4 pens. If this is the case, then there is no inflation. Last year also I am buying 1 pen at 5 rupees. This year also I am buying 1 pen at 5 rupees. Where is inflation? There is no inflation. So in order to compare one year with another year, it is compulsory that we maintain the quantity to be a constant. The quantity has to be kept a constant, okay, for the sake of measuring inflation. This is what we have to do. Okay, so based on that, a constant quantity of goods and services plus constant quality, not just quantity. It has to be the same kind of food that you consumed last year. It should not be a lesser quality food, or it should not be a lesser quality clothing. Last year you bought a clothing. So I gave you the example of BMW versus Maruti, right? Last year there was a car which was produced. This year there was a car which was produced. Both one car. You cannot say they are the equal. They have to be of equal quality to be considered. So here the quantity as well as the quality has to remain constant. Quantity as well as the quality has to remain constant. Okay, keeping the quantity as well as the quality constant, we'll ask a question: how much was spent on this basket of goods and services in, let's say, last year 2019? How much was spent? 2020, how much was spent? 2019, if we say, let's say 20,000 rupees was spent on this, and 2020, if we say 22,000 rupees is spent on this, then we can look at it and we can say there is inflation. Okay, so this basket of goods and services is what we are referring to as general. In creating this basket of goods and services, the organization which does this, and there are different organizations which does it, I'll tell you about it as and when we get there. These organizations have a standard reference material. It's saying that We are creating a basket of goods and services. In general, this is what is consumed by the people or consumed by this set of people whom we are considering. Okay, based on that, a basket of goods and services like this is arrived at. Okay, hope this is clear. Now comes the third part, price levels. Now, why are we using the word price levels and not prices? 20,000 rupees is the total expenditure. You can call it as price. So 22,000 is the expenditure. You can call it as price. General prices in the economy, you could say. But why do we specifically say price levels? We are bringing in another qualification here. We are asking a question. So we are saying, look at the consumer behavior here. Put yourself in the position of a consumer and ask yourself a question. If the price of entertainment increases by 10%, if the price of food increases by 10%, if your income is increasing by only 5%, it means that you do not have sufficient increase in income to continue consuming both food and entertainment at the same quantity. Will you or will you not decrease your quantity of consumption of one of these? You will have to decrease because you don't have the income to pay for it. So which one would you compromise on, food or entertainment? It has to be entertainment, right? There's no question about this. Food is an essential thing. Entertainment is an option for most of us, right? So you will be decreasing the quantity of entertainment consumed. However, if we change the quantity of entertainment consumed or the type of entertainment, quality of entertainment, it will create a flaw in our calculation system. That is why we said it has to be kept constant. You understand? We laid a condition earlier that the quantity cannot be adjusted. The quality cannot be adjusted. But the reality of people is that when the prices increase similarly in both the things, people choose one over another, which means some of these commodities are of greater importance to people, some of the commodities are of lesser importance to the people. If everything is equally important, we are going to say food has a weightage of 25%, clothing has a weightage of 25%, entertainment has a weightage of 25%, housing has a weightage of 25%. Why do I say 25%? Because there are four things. All of these are equal weightage, are equally important. That is not the reality. The reality is slightly different. So what do? We say food is maybe 35% important, while entertainment is only 10% important. Okay. While in this case, housing is 30% important, while clothing is, okay, continues to be 25% important. The numbers are correct, right? Yes. Now it comes to 100%. Now I'll say food is very, very important to me. That expenditure is non-negotiable. Housing is also, I'm living in a rented apartment. I have to pay the rent. There is no choice there. But clothing, maybe I can compromise a little. Instead of buying something, I may give a compromise and I may buy a lesser quality or a less number of shirts or whatever. And entertainment is something that I can compromise to an even greater extent. Okay. So based on our order of importance, what we are giving is the increase in the price of entertainment in the overall economy will only account for 10% increase in the overall expenditure. Whereas the increase in the price of food will account for 35%. Price of food increases, that contributes 35% to the calculation. Price of entertainment increases, it only contributes 10%. Okay. Similarly with clothing and housing. So different weightages are given. Okay. The moment different weightages are given, we really cannot calculate it in terms of absolute money. So instead, what we do in each of these cases, we create an index. We create something called as an index. We create something called as an index of these. The food will be given an index. Whatever is the expenditure on food, that will be measured, that total amount will be referred to as something like 100. Whatever is the total expenditure on clothing, we'll refer to it as 100. Whatever is the total expenditure on entertainment, we'll refer to it as 100. And whatever is the housing expenditure on housing, we'll refer to it as 100. And we'll say 35% of that, 25% of this, 10% of entertainment, 30% of housing. We'll add it all together. Okay. So for now, I will explain this in slightly more detail, if possible, at the end of by the end of today's class, which is not very likely, but mostly I'll explain in the next class. I'll take the example, give numerical examples, and explain it in greater detail to you. Okay, just keep this in mind. There is something called as an index which is created to calculate the price levels, to arrive at the price levels. That is why we are using the term, where is number 3, price levels. Instead of prices, we are referring to it as price levels, something that is representing. See, index is very simple. Okay, index is a representation of some value. Okay, to understand the importance of it, let's imagine that you scored 70 marks in an examination out of 100. Is this good mark or a bad mark? Is this a good mark or a bad mark? Some of you might look at it and say it is, people who normally score only 50 mark will look at it and say, oh, this is really good mark. People who normally score 90 out of 100, you look at it and say it's not very great mark, it's average mark. Yeah, I'll get scolding at home if I score 70 and go home. So you might say that. Okay, some people will say it's average, but you cannot really say that. You just cannot say that, because you are telling based on your experience from school or college. The reality is that you take UPSC examination, UPSC mains examination, the first rank holder has a percentage of 55, around 55. That is the mark of the first rank holder. Right? You write an exam for 250 marks, you get 100 or 110. That is a mark of the toppers you would have followed, which is less than 50%. 125 is 50%. It is lesser than that. Okay, this is an extreme case. Mostly it will be 48 or 49%. So these are very, very subjective depending on the kind. So in order to understand whether this is good mark or not, you refer it in terms of an index. What if 70 out of 100 is the first rank in the class? Then is that a good mark or not? It is definitely a good mark, right? So this is an index which represents this mark. That is the concept of index. An index is a representation of some other value. It helps us make more sense out of that value. That is what is an index. Okay, we'll get into the discussion of about index a little more in detail when we get to measuring inflation. We will come back to this discussion. I will give you a mathematical explanation of this when we get to measuring inflation, this part. Okay, for now, all that I'm trying to convey to you is that each of these words have a relevance to it. Persistent, because it has to last over a period of time. General, because it is a set of goods and services overall in the economy. And price levels, because we are using an index, because the relative importance of some commodities are higher in comparison to other commodities. That has to be considered. So general price levels in the economy. Okay. Moving on. Inflation can also be defined in one more way. I think a couple of people, Tanuja, Rini, I think 2 people answered it. There is another way. Inflation can also be defined as decrease in the value of money. Decrease in the value of money. Rini and Tanuja, yes, these are the 2 people who answered that. Now, understanding this is not very difficult. It might look like that. Think of this. Last year, you bought 2 pens. Last year, you bought 2 pens and you spent ₹20. Okay. This year, you are buying 1 pen. This is 2019. This is 2020. This year, you are buying 1 pen and you are spending ₹20. Or let's say 2 pens you are buying, you are spending ₹40. Okay, so this is inflation. Price of 2 pence 20 rupees last year, price of 2 pence 40 rupees this year. This is what we call as inflation, right? Rise in the price of a particular good. I'm taking the example of one specific good to understand, to explain the concept. Okay, so 2 pence cost 20 rupees, 2 pence cost 40 rupees. This is inflation. Now look at it from the other perspective. At 20 rupees last year you could get 2 pence. 20 rupees had a value of 2 pence. With 20 rupees you could buy 2 pence last year. With 20 rupees this year, how much can you buy? How many can you buy? Only 1 pen. Now has the value of 20 rupees decreased or not? 20 rupees had a value of 2 pence last year. 20 rupees has a value of only 1 pen this year, which means that the value of 20 rupees in terms of what it can purchase, in terms of its purchasing power, or the value of 20 rupees in terms of commodities has decreased. With 20 rupees, you could buy 2 pens last year. With 20 rupees, you can only buy 1 pen this year. So the value of 20 rupees has decreased in this year. That is what decrease in the value of money. Your money is able to buy lesser commodities this year in comparison to last year. That is what is called as this decrease in the value of money. Okay. Now, I hope you have understood that. Okay. If you have questions, you're free to ask, but I'll assume that you have understood. If you have questions, ask me. I'll take it up as and when I see the question. Okay, there is one. And can we say that? Okay, Helen is asking, sir, can we also say that the pen's value has increased? Definitely you can say that. That is what is inflation, right? Increase in the price of goods and services means what? Increase in the value of pen. Yes, you can say that. The pen's value has increased. Okay, now on a related note, I'll explain another concept as well. Let us assume that your income in 2019 was rupees 100. Okay, your expenditure was rupees 100, evened out. Okay, assuming that the quantity and the quality of consumption is remaining constant, that is the only way in which we can measure inflation. Okay, 2020 your income increases to rupees 110. Can we say there is an increase in income? And I want you to respond quickly. I want you to respond quickly. Okay, can we say there is an increase in income? I'll be asking a series of questions. Be ready to answer. Sri Lakshmi says yes. Vamshi says yes. Archana says yes. Tanuja, Rini says yes. Okay, good. Good enough number of answers. Sarah says yes. Okay, there is an increase in income. Okay, now there is an increase on income, very, very visible. But what if the expenditure on the same set of goods has increased to 110? Now tell me, is there an increase in income? Now tell me, in 2020, is there an increase in income? Sarah says no. Archana says no. Rini says yes. Rini says there is increase in income. Tanuja says yes. Sri Lakshmi is smelling. Oh no. Sri Lakshmi says yes. Helen says yes. Ashwin says yes. I thought Sri Lakshmi would wait and not answer. Okay. Anyway, the answer is not very straightforward. The answer here is not very straightforward. The people who have a justification, the people who said no, you also have a justification. Why would anyone say yes? Because you'll say, look at it, evidently I was earning 100 rupees last year, this year I'm earning 110 rupees. Who can deny that there is an increase? No one can deny. There is definitely an increase in income. However, when you take into account your expenditure also, effectively, is there an increase in income? When you say increase in income, if you say that, okay, I've got more money than last year, then you should have that money to show. But you don't. Why? Your entire money is being spent on buying the same set of goods. You're not buying anything extra. You are buying exactly the same set of goods. That entire income that you earned is going in that. So effectively, Hashtag. Okay. Okay, guys, can you confirm if I am visible, audible? Yeah. Correct. Yeah. Perfect. Thank you. Thank you. Thank you. Yeah. Yes, Sanjay. Okay. All right. So be ready to again send messages. We were discussing that. So see, on the face of it, it is very, very evident that there is an increase in income. Okay. But are we able to do anything extra with that increased income? Not really, because for the same set of goods and services, we are having to spend that increased income. So here comes two concepts in economics, which is used exclusively in the context of inflation. There is something called as nominal and something called as real. Okay, nominal means what it looks like, and real means what the reality effectively. What is it? Okay, so now here we say here 2019 to 20 there is an increase in the income nominally, but in real terms there is no increase in income. Okay, so here we bring in a distinction between the concepts nominal and real. Nominal income has increased, real income has not increased. Real income is takes into account the question, what are you able to do with the money? Or in other words, real income is nominal income adjusted for inflation. So real value is nominal value adjusted for inflation. So if you remove the inflation from this income, if you remove the percentage of inflation from this income, how do you get the percentage of inflation? Between these, you will calculate the inflation. Okay. So you calculate the inflation here, and whatever is the inflation, if you remove that value from here, after that what you get is called as the real value. Okay, take this 110, remove the extent of inflation from this 110, what is left over is the real value. Okay, this is the difference between nominal and real. Nominal value does not take into account inflation. Real value is nominal value adjusted for inflation. After adjusting the nominal value for the percentage of inflation that is there, whatever you get is called as the real value. In this case, the inflation is 10%. I'll tell you later how to arrive at that. Simple question, simple equation. Present value minus previous value divided by previous value into 100. There is 10% inflation. If you remove 10% from this, you will arrive at the value of 100, which means last year's income was 100. This year's real income is also 100. You have removed inflation from this value. What you get is the real value. So real value, last year's income is also 100. This year's income is also 100. So there is no real increase in income. So, but nominally, this is the difference between the concept of nominal and real. This concept is applicable in a wide variety of areas. Even in GDP, there is a concept of nominal GDP and real GDP. Q into P. If the P is price which includes inflation, it is nominal. If you remove inflation from the P, Q into P, then that is real GDP. So we'll talk about all those later. But there is a concept of nominal and real. Keep that in your mind. Now, let me ask a few questions. You can quickly answer. Okay. 2010 itself, the income is 110. The expenditure on the same set of goods is 105. Is there an increase in nominal income and real income? Is there an increase in nominal income and real income? Yes, no. Okay, Anu has answered. Yes for both. Yes for both. Great. Okay, there is an increase in both real income as well as nominal income, but the extent of increase is different. Nominal income has increased by a greater extent, real income has increased by a lesser extent, because here the inflation is only 5%. You remove 5% from here, you will still have a value like 105, which means real income has increased from 100 to 105. Real income after adjusting for inflation. That is true. Okay, if this is rupees 120, the nominal income has increased, the real income has decreased. Why? With the new income, you are not even able to buy the goods that you were buying earlier, which means the real income has decreased while the nominal income has increased. Okay. All right. So these are some combinations that I wanted to check. If you have understood this, you have a fair understanding of the concept of inflation. This real versus nominal is a very, very important concept in understanding a lot of things that are happening in the economy. Okay. All right. Anyway, now that that is done, let's move on. So that finishes our discussion about the introduction, real income, nominal income, and all those. We are done with it. Now we'll take a look at. I already told you, inflation could be general, economy wise in nature, or inflation could be specific to a sector also. Sectoral inflation, food inflation, fuel inflation, or inflation in a particular industry, iron and steel. Maybe all those sorts of inflation is a possibility. Okay, so that is one. So sectoral inflation as well as general inflation, both are possibilities. Now coming to causes of inflation. Causes of inflation. Okay, let me ask you a question before I go here. Is inflation good or bad? Is inflation good or bad? What will be your answer? Obviously, the answer is not going to be yes or no. There is going to be a conditional answer. Why do I say so? We just learnt in today's class, in the earlier class, that the government itself is trying to create inflation. Did we not learn that? Q into P, what are the determinants of quantity of money? Inflation is a necessity if the government has to induce the producers to produce more. So the government says, please let there be inflation. So inflation is a necessity. Inflation is something that is good for the economy. So that is good. But inflation can also be bad for the economy, which is why in the index we have a heading called as, measures to control inflation. Inflation could be bad also. So now tell me, when is inflation good? When is inflation bad? That is what I want an answer to before I get to causes of inflation. Vamshi says it is increased. If it increases up to a limit, it is good. Archana says depends on the level of increase, causes and all those. But I need a more concrete answer. I have given you a more concrete answer. I want you to give me a more concrete answer. Yes, Lalit Kumar has given me the correct answer. Correct. Sri Lakshmi has also given me close to the answer. See, whether inflation is good or bad also depends on what is the extent of the growth in our income. If there is no growth in income, then inflation is definitely bad. Even the smallest inflation is bad because there is no growth in income. We don't have more money. But if our income is growing by 20%, even 15 or 18% inflation is not bad because we still have some real income left with us. But if the growth in inflation is income is only 5%, then even a 6% inflation could be bad for us. Okay, so which is where this entire concept which we are learning here will come into the picture. If the growth in income is greater than the growth in inflation, growth in price, then inflation is acceptable. If the growth in income is greater than the growth in the price or percentage of inflation, then inflation is acceptable. If inflation is greater than the increase in income, if the rate of inflation is greater than the rate of growth of income, then inflation is not good for the economy. And this varies from country to country. Why? What is growth in income? What is the rate of growth in income? Can someone answer me that question? I'm just asking you basic questions whether you understand economics or not. What do we mean by what determines the growth of income of the people of a country? Rini, you are correct. Mohammad Sadiq, that number of 2 to 4, it is true. But there is another reason for that. Sri Lakshmi says cost of production. No, correct. It is correct. But that is not the right phrase to use for that. The concept is correct, but that is not the right usage for that. Correct, Sri Lakshmi, correct. That's the right usage. Okay. What determines the rate of growth of income is nothing but the rate of growth of GDP. GDP growth rate. Okay. The more the GDP, the more the factor income of the people, right? What is GDP? Q into P, cost of production, you would say, value of goods and services produced. But where is that money going? I said it in the earlier class today. Cost of production is nothing but the factor income of the people. Money spent as various expenditures in the form of income to the various factors of production. That is what is the cost of production. That is what is GDP, which is why we say GDP is equal to national income. Right from the first class, we have been saying that when GDP increases, national income also increases. When national income increases, the income of the people also increases. Okay. India as a country, I'll tell you about the specifics later. India as a country is targeting a GDP growth of, let's say, 8 to 10 percentage. 8 to 10 percentage is what we are targeting. India as a country is targeting an inflation of 4 percentage. I'll tell you that about the target inflation later. Okay. So in a country like India, we are saying that we are targeting an income growth of 8 to 10 percentage, and we are okay with a price increase of 4 percentage. In a different country, let's say a country which has already reached a very high level of production, let's say a country like USA, they may themselves be targeting only a growth of 2 percentage, because that is their, see, you take a topper, someone who scores 98 out of 100, you take someone who scores 70 out of 100, who has a higher scope of improvement? The person who scored 70 out of 100 has a higher scope for improvement. Person who scored 98 can only grow very little. So take USA or some of the European countries, their rate of growth would be very small. So which means the rate of growth of income would be very small. For them, for countries which are targeting 2 percentage growth, even 1 percentage inflation may be acceptable. Anything more than that may not be acceptable for them. Okay. But in a country like India, 4 percentage inflation is easily acceptable. That is the ideal inflation for us. If it's less than that, it is bad because production won't happen. If it's much greater than that, then it becomes a problem. Right. So there is no particular rate of inflation which is good across the world. In some countries, a particular rate of inflation is good, acceptable. In some countries, something else is acceptable. What is acceptable or not depends on the income of individuals, income of the country. What is income of the country? GDP. Okay. So ultimately, whether inflation is good or bad depends on the rate of growth of the country. Okay. Now looking at causes of inflation. 1 minute left. I'll give you just a quick outline and then end the class for today. There are two major causes of inflation. Inflation is nothing but rise in price, right? In very general terms, rise in price. Okay. What are the places where the price is determined? There are two places where the price is determined. At the point of production, at the point of production, at the, not the point of consumption. Okay, we can call it as at the point of consumption. At the point of consumption. There are two people who determine price, or two areas where the price is determined. At the point of production, based on the cost of production. Okay. If the company is saying, I am having to spend 100 rupees to produce this good, is it possible to sell this product at less than 100 rupees? It is not possible, because that is the cost of production. You determine the price of a product based on the cost at which it is produced. That's number one. Okay. The second one, you bring it into the market. So this is the market. You bring it into the market. Then comes the second thing, people who are consuming it. Okay. How much is a consumer willing to pay for it? If the consumer comes and says, I'm willing to pay 120 rupees to buy this, then the price will become 120. Okay. Then the price will be determined as 120. Now, what is this? This is nothing but supply. This is nothing but demand. These are the two factors which cause inflation. Supply and demand are the two factors which cause inflation. Causes of inflation, number one, demand can cause inflation, supply can cause inflation. When the demand of a product increases, it may result in inflation. Did I say it will result in inflation? No, I said it may result in inflation. Similarly, when the supply of a product goes down, like I gave the example of lorry strike, onion that is available in the market goes down. So supply of onion goes down, price may increase. Or if the cost of production itself increases, the price may rise. Right? Demand, supply. Two factors which cause inflation. Okay. I shouldn't be taking any more time, right? 7:30. Did you have a class in the morning? If you are smart, you will answer correctly. Okay, anyway, so I have taken a pause. So just leave it at this. Demand and supply is what causes inflation. Now, what we have to learn next is what causes demand. What causes demand? Okay, what causes demand means what causes increase in demand. Yeah, and supply is said what causes decrease in supply. These are the two factors that we have to learn now. So next class, when I come and ask you how much have we completed, what do we have to complete, your answer should be these are the two things that we need to start next. What causes increase in demand and what causes decrease in supply. Okay, so we'll end the class now. Please revise and come next class. When I ask you something, don't just turn and look at the page and then say, oh, okay, this is what we had learned. I saw a couple of people doing that. Only a couple came on video, so I saw both of them doing that. So yeah, see you in the next class. Thank you so much for your participation. If you have any questions, you can ask me. I'll respond. And if you have I given my mail ID to you in the last class? I have given my mail ID, right? So you can drop a mail to me if you have any further queries, but I'll wait here for the next 5-10 minutes. If you have any questions, I'll answer it. Thank you, Sri Lakshmi. You take care too. See you next class. All right, Kishore, can I explain NRI bank accounts? All right, I don't know if I was audible for the last 5 minutes. I was talking. Okay, just hold on. Yeah, I am audible. Okay, great. Yes. Okay. So, couple of questions. Kishore, you want me to explain the concept of NRI accounts? Which one, Kishore? Kishore, can you come on audio? Is that possible? If you could raise your hand, I'll give you permission to. Yeah, great. 1 second. Yeah, you can talk now.
Sir, can you explain on the non-resident external rupees count and the another one, the foreign currency non-resident banking account? Yeah, sir, both.
Kishore, what have you understood out of it?
Sir, I understood both. When a citizen is turning into a NRI, like his account will normally turn into NRI accounts. Okay, if he is getting a money from a country which is richer than India or which the currency value is higher than India, it will be a non-resident external rupees account. And if he is going from a poorer country like African countries or Sri Lanka and all, that account will be a NRB account. Is it so?
Don't learn all these things. Very simple, okay? If a foreigner, if not a foreigner, if an Indian residing outside India, NRI, wants to deposit money, there are two options. Okay, either they can deposit their money in Indian currency itself, which means they'll convert their currency, foreign currency, into Indian currency and save it in India, or they can deposit the money in foreign currency itself. There are two options. Okay, if they want to deposit their money in Indian currency, they'll create an account called as non-resident external. The name itself says non-resident external, in bracket rupee account. Rupee is the denomination there. Everything is measured in rupees. So whatever currency that they put, it will be converted based on the present value of that currency and it will be stored in rupees. The interest calculation, everything will be in rupees. In FCNRB, in foreign currency non-resident account, a non-resident will have an account. When he or she deposits money from abroad, that money will be calculated in that particular foreign currency in which they deposit. That is all. That is what you have to learn. Then comes the question, why is it so? Why do we have two different kinds of accounts? The problem is that if the intention of the person is to take the money back, I deposit my money in India, but I want to take it back to whichever country I am from. If the person is depositing money from a stronger country, from a country whose currency is stronger than India, and if they deposit in NRE account, they might face a loss due to exchange rate, changes in exchange rate, which I have already explained 2 times, once there and once as part of historic rate of exchange. It's the same concept. $100 you put, if you are going to take back in rupees, it will be much lesser when you take back. So they might opt for people who are depositing their money from countries whose currencies are stronger than India. They might actually choose FCNRB account because the entire money is stored in foreign currency itself. Whereas if you are from a country whose currency is weaker than India's, then it doesn't make sense to save in that foreign currency. So they'll say India is a stronger currency, I want to save the money in Indian rupees itself. So they might choose to opt for non-resident external rupee account. But there is no rule that they have to. They can choose which account that they want to create. And the bank has to give them permission to do that. I hope this is clear, Kishore. The concept is
actually one more query arises.
Yeah.
Normally, when if you see the developing countries, the rate of interest will be very low. For example, the Japan and all, they need to pay negative interest. The depositor need to pay
that
some
is
money.
Country or developing country?
Very well
country or
developed
developing country?
Developed
very well developed. Okay.
Okay. By the conditions, normally the NRIs would tend to deposit in India. By the time how India compensates.
Sorry.
By the time.
What was the last?
No. By the time how the banks are compensating, sir. For example, they need to pay some 6% or 7% rate of interest. Okay, but by the time the amount, if they are spending in dollar for 100 and 100, they need to give $106. When they deposited, it was just 70 rupees, 70,000. When they need to take back the money, it will be some 80 rupees. It will be around 8,480 rupees. So, Indian banks need to acquire a much loss.
Correct. It may lead to a loss.
Now, by the time how we are, our government is encouraging, or what is the regulation?
Government is not doing anything. It's business after all. How the banks deal with this scenario is, see, the first question, there is no compulsion on the bank to accept it. The bank may say, I cannot accept it. It's a loss for me. The bank may not accept it in the first place. Okay. Or the bank, see, the condition in which the bank will agree to accept is if the bank feels that it can use this money to make a profit out of it. And what do I mean by that? Let's say that dollar or yen or something is deposited. If the bank feels that there is a lot of demand for this foreign currency, then what they'll do is they will exchange this foreign currency with an importer and they will charge a fees for that exchange that happens. Right? And then they may make some money out of it. And also, you look at someone is let's say someone is depositing from Japan. Okay. Japan has negative interest rate, right?
Yeah, sure.
Yeah. So even if Indian bank offers 2% interest, is it not profitable for that person?
It will be profitable only, sir.
So Indian bank will only offer 2%, not 6 or 7 or 8%.
Okay, sir. Okay.
So whatever is the rate of interest in the foreign country from which they are depositing, India will only offer slightly more than that, not as much as how much they are offering Indians.
Okay, sir.
Okay, that's how they'll try to avoid loss.
Sure, and one more query, sir, regarding that loan moratorium cases which are all pending for the Punjab and Maharashtra national banks.
Okay.
Why the customer cannot able to find still or idea?
Your voice, sorry, can you ask that question again? Why
For
the customer?
example,
No, your voice is breaking, Kishore.
okay, so moratorium.
Your voice?
Okay, now is it okay, sir? Now
Now
is
it
it
is
okay?
better. Yeah. Go on.
Okay, sir. Just
No, your voice is again breaking. Sorry.
regarding loan mortgages. Okay, sir. I will you, sir. I will mail you.
Yeah.
Thanks.
Do mail me. Yeah, sure. Okay, Sarah, if you're there, can you raise your hand? Yeah, so you can unmute yourself and ask me your question.
Yes, sir. That is. I understood that money.
Am I pronouncing your name right?
Sorry, sir.
Can you pronounce your name? Am I pronouncing it right? Is it
Yes,
Sarah or
sir.
Sarah?
It's Sarah only, sir.
Sarah. Okay, go on, Sarah.
Sir, that is. I understood. I didn't only like understand the explanation part that you gave for the formula M3 by M naught.
So that is what you want.
Yes, sir.
So money multiplier, I said, sorry, money multiplier, I said is equal to M3 by M0, right?
Yes, sir.
So just stay connected. Don't mute yourself. If you have questions, feel free to interrupt me and ask.
Yes.
So all I'm saying is that in a particular year, let's say we are talking about a very fresh economy, okay, where
Yes.
the RBI and the government has no idea about what is the banking habits of the people.
Yes.
So RBI brings into circulation, let's say 100 rupees. RBI is bringing into circulation 100 rupees. And then what they are doing is they will keep monitoring what is the amount of money which comes into the banking system. And then they'll keep monitoring that. And then they'll arrive at something called as M1, then M2, and M3.
Okay.
M3 is the total amount of money that is there in the banking system, which is inclusive of M2.
Okay.
M2 itself is inclusive of M1. So it will take into account all the money that people are holding in their hands, all the money that they're depositing as 1 year deposits, all the money that they're depositing as longer deposits, everything is included. So how much is the money multiplying to? Ultimately, how much money do people believe that they have? That is what is M3.
Okay.
Let us say people believe they have 350 rupees in their hands. Why? Because people, it's not just a fake belief. It is not just I sit and believe that I have money. No, I have definitely put money. I have actually put money in the bank account, which is why I believe I have money. Similarly, so in the bank, we take a look at how many deposit accounts are created like that and how much money is there, which is what we did in M3. Remember, M3 is equal to M plus money which has come in this form. In M2 itself, we say money which has come in this form, this form, this form. In M1, we say money in this form. That is why we learned that formula. And in M3, we have an ultimate value of total money which actually belongs to people. Okay, that is what we write on top. Then we say 350 rupees is what people own in the economy, but in reality, 100 rupees is what we printed.
Okay.
So we say money is multiplying by 3.5 times. 350 divided by 100 will give you 3.5. So we say money is multiplying 3.5 times. How much ever money RBI prints, it will have a value equal to 3.5 times because of the banking habits of the people. Now, why is this relevant? Next year, this is not relevant. Next year, RBI has to answer a question, what should be the M0? How much money should be printed by the RBI? That is the bigger question. So to answer that, they'll say M3 divided by money multiplier. So what is M3? M3 is the targeted GDP. How much money should be there? How much ever goods and services are there, that much money should be there. We answered that as the first question.
Yes, sir.
Yes.
Yes.
So whatever is the targeted GDP, that divided by money multiplier 3.5 in this case
Okay.
will give an idea about how much of physical currency should be printed by RBI. That's all.
Okay. Got it, sir.
Clear?
Yes, sir. Thank you, sir.
All right. Welcome. Okay. One more person. Tanuja, are you still there? If you could raise your hand. Tanuja, you said you completely lost connection, is it? Okay, so if you have lost connection, then you would not be able to ask any particular doubts. Can I explain other deposits with RBI? Yes. See, other deposits with RBI includes, see, there are, why do we say other deposits? Because the previous term is bankers deposits with RBI. Bank has to keep some reserve, which they keep with RBI, cash reserve ratio, about which we'll learn in a later class. In inflation, we'll learn that. Okay, that is what we call as bankers deposits with RBI. In addition to this, there are some other deposits with RBI. What are examples of that? Staff of RBI, their salary account and all their related accounts, that is created, that is kept in an account of the RBI itself. Now imagine you are an employee of RBI. You are in key decision making positions, let's say, okay, and you have your account with SBI or ICICI Bank. Is there not a chance that you, being a regulator, will make a policy which is favoring one bank in which you have an account? It's a possibility. So to prevent that, all the staff of RBI have an account with RBI itself. Okay, so that is one of the other deposits with RBI. In addition to that, the President of India, the government itself, all their accounts are maintained with the RBI. They deposit money, that is also other deposits with RBI. In addition to that, we might become members of some international organizations like IMF, for which we may have to pay some membership fee. Some of that payment is done in Indian rupees. So when they cannot do anything with the Indian rupees, that money they give it back to the RBI and say, you give me regular interest on it. That is also other deposits with RBI. I hope this clarifies for you, because you had not listened to it. Tanuja, is that clear? You're welcome, Sarah. All right, Tanuja. So if that is the case, then we can disconnect. There are only 4 people left. Tanuja, Lalit, Akash and Anu. If you have any questions, you can ask. Else you can disconnect and leave. Yes, Akash, did you ask a question earlier? Welcome, Tanuja. Did I not answer any question that you asked? Go on, Akash. How currency in circulation is determined? Akash, currency in circulation, what is the formula that I gave you? In M0, I said currency in circulation, right? In M0. So currency in circulation is equal to currency with the public plus currency with the banks. Now currency with the public, it is not possible to determine, because people will not say how much they have. So the only way is currency with the bank is determined. RBI will know how much money they printed. So printed money minus currency with banks minus currency with RBI itself. This will give us the value of currency with the public. That is how we calculate currency with the public. Once we know currency with the public, once we know currency with the banks, that together contributes to currency in circulation. Is that clear, Akash? Okay, welcome. You're the only one left. If you disconnect, then we are done with the class. Thank you so much.